welcome to the video. This is trading for beginners, or trading for dummies as the thumbnail says, and the goal of this video is to get you from struggling or zero profits or complete beginner right through to consistently profitable trader, which means it's a complete and comprehensive program all in itself, which means it's going to be a long video. But my goal is to get you to consistently profitable trader after watching this video. And that's a bold claim, but this is something I've been meaning to put out for years and years now, because there is so much crap out there and there's so many educators and fake gurus and scams trying to take your money and not providing any value in return. So I had enough of all of that, and I thought I'm just going to give everything away for free to the trading community once and for all, and I'm going to invite you into my trading office as I walk you through every component you're going to need directionally correct so that you get there as quickly as possible without all the fluff, without all the showmanship, and by the end of this program you are going to be the most confident and competent trader that you could possibly dream of being. So if that sounds good to you, I encourage you to bookmark this video, put it into your favorites, subscribe to the channel if you want to, and over the sections of this video I'm going to be covering what your expectations should be, what you need in terms of the gear, the basics, how to read price, finding your way around a chart, understanding what Forex or trading actually is, and how to navigate the markets. I'm going to teach you how to read price, I'm going to teach you how to identify patterns that happen frequently in the market, and then I'm going to teach you how to build systems out of those patterns, and then how to go and test those patterns, and then how to go and trade them live. I'm going to cover everything from brokers to gear to platforms to price to markets to everything. By the end of this video, there's not going to be anything that you're going to need other than to go and practice and become better and better. So why am I doing this? Well, some of you might know me, some of you might not know me, some of you might be subscribed to my channel, and over the years I've built a phenomenal community in the trading community, and the reason for that is through transparency and vulnerability of sharing my own trading insights. My money isn't made from education. My money comes from investing my portfolio and making my money work for me. Since the age of 22, I've been investing my money into various investments, buying businesses, buying stocks, putting it into index funds and ETFs and REITs, and speculating and becoming a trader, and basically using my money and putting it to work in a way that allows me to grow it as quickly as possible, that provides me with an income. And in doing so, I became completely financially free by the age of 29. Now, at the age of 29, when I became financially free, no one knew who I was. And after seeing all the crap out there online about trading, I decided to just let everyone watch me trade. Let everyone see how a real trader goes about their day. If I was going to be doing it anyway, I might as well share it with you guys, and that's exactly what I did. And in doing so, over the years, I've become recognized as one of the most transparent and generous traders in the trading education space. I've become very close friends with some of the best trading prop firm owners in the world, some of the most reputable trading psychologists in the world, and I've spoken on some of the most respected trading stages across the globe as well. I started sharing my trading routine with the trading community almost 10 years ago now, and in this video I want to combine it and compress it all down so that you walk away feeling as if you've got more value from this one video than you have searching the internet for months and months and months, maybe even years. So why am I giving a completely comprehensive course away for free? Well, here's the truth. Over the years, there's been many scammers set up accounts. There's hundreds of fake accounts of me, and what they're doing is they're contacting people trying to scam their money, and I don't want people to lose their money. If you're going to become a good trader, the whole point is that you build wealth and keep money and not blow it and give it away and lose it, right? You want to build wealth, and that's my goal as well. So I don't want you to lose your money. So what could be the best move that I could make in order to eliminate those scams? Well, just share my best information so that everyone comes here and then there's no question of what's the real deal. And not only that, you'll learn so much in this lesson that you won't need to go and give your money and invest with other people, because you'll be empowered and you'll be able to do it yourself. I've got a much bigger cause to help people and empower people around their finances and become financially free. I believe that when we're free and able to focus on our most meaningful work, we become better human beings. So my goal is to get that message out to as many people as possible, and I hope after you've watched this video, you're going to get so much value from it, you're going to feel compelled to share this with everyone you know and help me achieve my goals. Sound fair? All right, well, if that sounds good, we're going to get stuck straight in. What I would say is make sure you bookmark the video again. Second of all, get a method of taking notes, okay? Commit to this program. This is something you're going to want to take seriously. Don't treat it as another YouTube video. This is going to be your textbook for learning how to trade. This is going to be your curriculum. This is going to be your qualification. So make sure you set up some time aside in your diary to keep coming back and revisiting this thing consistently until you get it all complete. Okay, are you ready? Let's get stuck in. All right, so hopefully you've got a method of taking notes now. We're going to get stuck in. But before we get stuck into all of the technical stuff, which I'm going to do in a way that doesn't overwhelm you or confuse you, I want to give you some expectations, because when you've been clicking on this video, before you clicked on this video, one of the questions or two of the questions in your head was, how much do I need to trade? How long is it going to take me to learn to trade? You know, what? Yeah, and some other expectations that are unclear, such as, what does it involve? You know, what do I need? What am I the right fit for it? So I want to cover some of that stuff off, and this is really important because I want to show you a way to understand how long it's going to take you, how to know how much money you're going to need, okay? And that's really going to be motivating for you, because when you see the truth about this stuff, you can actually forget about it and put it to the side, and it will give you the motivation to focus on the actual learning. If you're trying to do it in a way where you're really pressurized to make money right now, or you're really pressurized to make it work, it's going to have an effect on your mental state. In fact, there was a survey done in southern India where they tested 56 cities in southern India, and they tested the farmers' IQs. And when there was a drought and there was no trade and no market, and it was all low economy, you know, the economy wasn't very great, their IQ dropped by 30 points. And when it raised and it was booming and trade was great, their IQ raised by 30 points, which means this: when you're in a level of poverty, okay, meaning that you can't quite afford your own personal comforts, your IQ drops. Now, the thing with trading, you're going to need to be switched on as you're learning. You're going to need to be full focus as you're learning to trade. If you've got something eating away at your animal brain, telling you, oh, we can't afford to pay the bills this month, then that's not going to be the best position for you to learn to trade. But by knowing these numbers is going to either give you the chance to go, wow, you know, I can definitely do this, or you're going to go, well, maybe I'll come back to this later. So it's really important you understand this stuff. So the first really important thing you want to know is, how much money do I need to get to where I need to be in my trading? Like, what's going to make it worth it? And the first answer to that is, trading is one of the most powerful ways to accelerate your wealth if you can be consistently profitable, because the returns that you get on trading, as it's high speculation, the returns are greater. The more you use your skill to grow your money, the greater the returns. So the question is, well, if you're going to put it in a bank, you know, the bank are going to pay you 1% a year if you're lucky, probably 0.2% at the moment. So then it comes down to, well, do I actually want to trade? Do I actually want to learn to trade? So my first piece of advice is, you're going to have to want to trade. Like, you're going to have to have an interest in it. You're going to have to really enjoy looking at the markets, because if you don't, it's probably not going to be worth it for you. And the reason I say that is because you can go and get better returns focusing on something you really enjoy and love, and then or give your money to someone else to look after, than you go and have to learn something that you really don't want to learn to then grow your money, right? So that's the first consideration, is, if I put it in a bank, I'm going to get nothing. If I learn to trade, I'm going to get great returns if I can master this, right? So that then comes down to, do I actually want to learn to trade? But the first starting point I like to tell people is, think of a figure that you need to cover with your trading returns. So it might be your full income. You know, if you're earning 2,000, 2,500, 5,000 a month, or whatever that figure might be, write that figure down, whatever that might be. So you might want to cover your whole income, your monthly income, which might be £2,500, or you might just want to bring in an additional £500 a month or something like that, right? So we'll go with that example for now. We'll just say 500, could be dollars, pounds, whatever. And what you're going to do, just kind of get some idea of what sort of returns you will get, or how you can start to approximate that figure, is we can play around with some figures. So all we need to do is take that figure, whatever that figure is, and next to that, I'm going to write 2%, 4%, 6%, okay? And all you do is you divide this figure by 0.02 or 0.04 or 0.0 6, and what that's going to give us is some returns, some monthly returns. So if I divide 500 by 2%, I'm going to get 25,000. If I divide 500 by 4%, I'm going to get 12,500. If I divide it by 6%, I'm going to get 8,333. And what does that mean? What does this figure mean? Well, this is the amount that you would need in your account if you were trading it and getting 2% returns per month based on 500, and you was trading, 25 grand a month, and you was getting 2% per month, that would generate £500 or dollars. If you had a 12.5 grand account and you was getting 4% returns consistently per month on average over a long period of time, that would give you 500 a month. Same goes for 6%. If you was trading £8,333 in your account, and you was doing 6% on average over a long period of time, that would approximate £500 or dollars per month. Make sense? So have a play around with some figures and put them against some percentages so that you can start to see, right, okay, I don't need millions in my account to generate what I need. Actually, I need this much or this much, and I need this percentage return. Now, you're not going to know your percentage return right now. On average, that I see, the best traders get between 2 and 6%. It varies. And I've worked with prop firm owners and prop firm 7-figure traders on prop desks, and I've seen them get anything from 2% to 6%. And yes, there's going to be times where you're getting 10%, you might even get a 20% month. But the point is this: you need to focus on returns over a long period of time. And I'll talk about that later on in the program. Now, the other thing to pay attention to here is there's going to be other influences like inflation, like your lifestyle costs, your performance, all this kind of stuff getting better as a trader. So it's a good place to start, but you're also going to want to factor in, you're going to want to leave some money in the trading account so that you can grow it and have that compounding interest in the account as well, right? So there's a few other factors that will play into this, but this is a great place to start if you're a beginner, to visualize how much you'll need to generate a certain return. And really, the purpose of this exercise is linking the relationship between the two. Now, this brings me on to the next point, which is time. How long will it take me to learn to trade? Now, I can tell you this. Usually, it takes between 12 and 18 months to become consistently profitable as a trader. That's what I've seen working with thousands of traders over many, many years, and I've seen that be the common kind of sweet spot. Does that mean it's going to take you that long to learn how to trade? No. It can take 6 months to really learn this and master it in your mind. It can take a little bit less, or it might take a little bit longer, but 6 months to learn. And then why does it take 18 months to become consistently profitable? Well, here's why. Imagine this line here is 18 months, okay? And about here is 12 months, and this is 0 months, right? In this period here, 0 to 6, you might learn, okay? In this period here, you're going to want to go out and do some demo trading and what we call paper trading. So once you've learned, you're going to want to go and open a demo account, which I'm going to show you how to do, and you're going to want to be doing some testing, okay, or some demo trading. And then the reason this period is here is because this totals 12 months. Now, why do we give a 12-month period there? Well, the thing is this. When we're looking at the profits that we want to return, we want to know certain in our mind that we're capable of generating those returns, right? So it's best to take an average 12-month period of your trading performance before you commit to going, well, I'm going to give up my weekend job, or I'm going to, give up my job entirely. You're going to want to give it a 12-month period of trading how you've learned how to trade to prove to yourself that you can actually demonstrate those returns over a 12-month period. And the reason a 12-month period is good is because you can see all the different seasons, all the different holidays, the different news events, the different inconsistencies within the trading year, and then you can take the average performance over a 12-month period and say, right, I can confidently generate £500 per month based on this return, and this is my performance. And you have supreme confidence to go into the following year with a live account. So 6 months to learn, 12 months, 6 to 12 months to do some real testing, tweaking, going live, and then 18 months to really kind of fine tune and get the confidence to become a consistently profitable trader. And remember, you're learning a skill like anything. If you went to learn the guitar or the piano or learn to play golf, it's going to take a bit of time. And this is another reason why you actually have to have an interest in this and you have to want to make this work. Because when you think about it, the payoff in such a short period of time, I mean, even if it took you 3 years, that is a blip in your life, right? As to what this can do to transform your life, to get you to your financial goals. So I hope that makes sense. The next thing I want to touch on is this. A lot of traders, they overestimate what's achievable in a very short period of time. So I've just told you 6 months, 12 months, you'll be able to trade, 18 months, you'll really start to nail it. Well, that's not a long time, but a lot of traders, because of the way it's advertised out there and because of these idiots out there telling you it's easy and they're like telling you that anyone can do it, well, in your mind, you're thinking, this should take a week. I could go on a 2-day trading course, which people are selling, right? And learn to trade in 2 days. Well, that's rubbish. But what happens is they have this unrealistic expectation and they overestimate what's achievable in a very short period of time. And then when they come on, and work with me or, they get the truth, they go, oh, this is a bit harder than I thought. And then they underestimate what's achievable in a 3 to 5 year period, which is, magical really for how it can transform your life. So I don't want you to be overestimating. I don't want you to be underestimating. I just want you to commit to this process. And I promise you that if you apply what you learn in here between, in the next 12 to 18 months, your life is going to look a lot different when it comes to managing your finances. All right, the next thing I want to touch on is consistency. So if you want to be a consistently profitable trader, the first thing you need to master is being consistent in your trading, okay? Sounds obvious, but a lot of people neglect that and they're all over the place, jumping from system to system or doing it at different times, different time frames, and they're not consistent. Think about this. When can you consistently dedicate your time to learning to trade and dedicate your time to trading? Is there an hour slot on a Monday morning? Is there an hour slot on a Saturday? Can you do all Saturday? Is there a 3-hour slot on a Sunday? What you don't want to do is start as, you want to start as you mean to go on. So what you don't want to do is start trying to do it when you're about to go into a meeting or kids got to do the school run, take the bins out or whatever it might be, right? And you're kind of half in, half out. You want to allocate blocks of time into your diary. So pull up your diary and say, right, I can do Monday between 8 and 9. I can do Thursday 10 p.m. to 11 p.m. And I can do a couple of hours on a Sunday and maybe a Saturday afternoon or something like that. And once you've got these times blocked into your calendar, make that your time. Even if you're just learning at this stage, not just looking at trades or taking trades, actually learning how to trade as well, because if you can start with that, then you can just base everything off of that, and when we go forward you can build a trading system that works around that trading time. Because if you try and do it outside of those times, it's going to make it hard for you. Think about if you were trying to lose weight and you didn't really like running and you didn't like certain foods, and then you go to a fitness instructor and they say, right, you've got to run and you've got to eat these foods. Well, that's not going to work for you, is it? And it's not necessary either, quite frankly. You can lose weight building a system that works to your wants and needs and your likes. So we'll do the same with the trading. So consistency is key. And I've got a rule of thumb. People say, well, how long should I spend looking at the chart, or how long should I spend dedicated to learning? If you can get an hour a day on average over the week, that's great. So if you can get 3 hours on a Sunday and that averages out, 3 across the week, well, then how can you make up another 4 hours, or how can you make up another? The more you do, the better, obviously, but an hour a week, an hour a day, what I find, it builds momentum. And you get motivated because you make progress quicker, you're treating it more seriously, you're putting some time and effort into it, so you're committed to it. So you're just treating it more as a professional. And if you can get an hour a day on average across the week, which is 7 hours per week, great. If you can do less, don't worry, but make sure it's consistent. If you can do more.
Evet hocam, ne diyorsunuz?
Şimdi devre arasına 12-0 geride girdik. Soyunma odasında çocukların karşısına geçtim, dedim ki siz bu skordan razı mısınız? Değiliz dediler. Razı mısınız dedim. Değiliz dediler. O an maçı çevirebileceklerini gördüm. O an dedim ki bu maç döndü. O an hatta şampiyonlukları gördüm. Kupaları gördüm. Bizi Latin popçularla buluşturacak azmi gördüm onlarda. Çıktılar, 4 tane daha yediler. Halbuki razı olsalar 12'de biter bu iş. 16 çok. Şu an herkes bizi konuşuyor ya. Siz de yedikçe abartıyorsunuz oğlum. Eğer hala yeriniz varsa dankek magma. Rahat ol. Kime diyoruz ya? Size şu taktikleri verebilecek dünyada 3 tane teknik direktör var. Biri ben değil ama var. Yani gelse şunu verirler. Olabilecek tüm varyasyonlar burada. Tutmadı mı öbürünü dene. Al feryatı. Şebnem'le yer değiştir. Ya şu çekmeden önce kendinize şu soruyu bir sorun. Benim daha önce oradan golüm var mı? Yoksa vurma. Rakip de ayıp etti ama şimdi. 16 nedir? 4'ten sonrası hiçbir işine yaramaz. Senin gol atmayı bıraktığın an bitiş düdüğüne denk gelmemeliydi. Abarttılar abi çok.
If you can do more, great. Okay, so that just leads us on, just before we get stuck into learning all of the great technical stuff, I just want to say one more thing, and that's really around accountability. When you're learning to trade, there's going to be lots of benefits that you didn't see were there originally. So you want to trade primarily to make more money, right? But there's going to be other benefits, like you're going to think more objectively. You're going to understand people better. You're going to lose FOMO and fear of missing out. You're going to, focus on long-term success rather than short-term quick wins. So there's all of these kind of benefits, these hidden benefits to learning to trade that you're going to benefit from, not just making money, which is amazing. So it's a great place to be, it's a great thing to do, but it's very lonely. Not many people learn to trade. Not many people are traders, and there's not many people you can talk about trading without them thinking it's some kind of scam or you're a kind of crazy gambler, for the reasons I just mentioned previously, right? The way it's advertised and all the scams out there and the rest of it. So what I would do is I would counter that. I would get people on board by telling them what you're doing. Okay, and don't be afraid to tell them, I'm learning to be a professional trader. If you was learning a guitar, you'd say, I'm learning to be a professional guitarist, and they wouldn't laugh at you, right? But you've put it out there. So people might laugh, smirk, and think you're crazy, but just go with it and say, look, if I don't get anywhere in 18 months, 2 years on this, then you can, ridicule me all you like, but it's probably down to me just figuring out it wasn't for me anyway. But just tell them. Open up. Tell your family about it. Tell your kids. Tell your wife. Tell your husband. Tell your partner. Tell your family. Tell your colleagues. Tell everyone, because it's not a taboo anymore. It's something that you're doing, you're working on, you're becoming a professional trader, and you want to open up about that. You want to be, you want to be open about that, and you want to be proud of that. So let everyone know, get everyone on board, and what it also does is it allows them to respect your learning time. When you've blocked it into your calendar, that's your time dedicated to working on your future. You have to put yourself first in this case, because if you don't get to where you want to be, what good are you to helping other people? You're not really living the life that you really want, otherwise you wouldn't be watching this video. You know that you can do this, you're really interested in this, and you absolutely can do this. You need to give yourself permission to put yourself first to learn this stuff if it's something you really want to do, and then you can serve your family and your friends and your colleagues even better. And lastly, on that point, I want to say, just get around other traders, professional traders. Stay away from forums and those kind of Discord groups that are like really spammy and everyone's got an opinion. Get around some real professional traders who are all working on the same goal, like-minded people. And I'd invite you into my group, which is below. You can click the link in the description of this video to join my group of professional traders, completely free. We're all working on becoming better traders, including myself. Being around other traders and like-minded people who are working on the same goal gives you that belief transference, that confidence, and that momentum to continue on your trading journey. All right, with that said, we're going to get stuck into learning the cool stuff now. So I hope you got value so far. Grab a pen and paper, or you might want to pause it and come back when you're ready to start learning all of the technical stuff. Let's get stuck in. All right, so before we start digging into finding some of these opportunities and being able to actually place trades, we need to know what we're looking at. We need to read the markets. We need to read the charts. We need to understand this language. And really that starts with understanding price movement. Now, I already mentioned that those candlesticks or bars, those indications on that chart, are the movement in price within a certain time period. So what I want to show you now is the anatomy of each of those bars or candlesticks and how we read them and what each thing means when we're looking at price relative to time. So each one of these candlesticks in front of you here, they look very similar to the ones that are on the chart. But you're probably thinking, well, some of them were green, some of them were red. Well, let's just break that down a little bit. The first thing you need to understand is there's 4 components of a candlestick, okay? And that is the open price, the close price, the high of the session, and the low of the session. Because remember, one candlestick can be an hour, it can be a day, it can be a month, it can be 15 minutes, whatever. It's always going to have those four components. In other words, what that means is, let's just say that these candlesticks here in front of you are the hourly candles, which means bang on the hour, o'clock, we're going to have the open of a new candle and the close of the previous candle. So where is the open on this candle? Well, remember you saw red and green candles on the chart that I explained that I showed you guys just now. A green candle means, what a green candle means is that we closed at the end of the hour higher than we opened. And when you see a red candle, conventionally, it doesn't matter what color they are. People use different colors for different candles, and conventionally they were white and black, or they were hollow and white. So over time, usually green is for bullish or up candles, and red is for bearish or down candles, meaning when it's green, we close at a higher price than we opened, and when it's red, we close at a lower price than it opened. So let's just start by coloring in these candles here. So I'm going to color this one here green. Okay, so this is our up candle. This means that price closed higher than it opened, and we'll have a red down candle as well, and meaning that price closed or the candle closed lower than at the price it opened. So how do we identify where it opened and where it closed? Well, let's start there. So in a green candle, we got the four components. Okay, we've got this, we've got this, we've got this, and we've got this. Now you probably guessed this will be the open price. Okay, so whatever price this was on the chart. Remember over on the right hand axis we had the price points down here, and we had 1.3055. That price point will be the price at which that candle opened. Okay, then this will be where the candle closed, and then obviously in between that, this would be the high of the session, meaning the highest price that the market pushed up to during that candle, and this would be the low. And what we're looking at in this one body of a candle is a story of what happened during that hour. We can see how high price pushed up, how low price pushed down, where the candlestick opened on the hour, and where it closed on the hour. Make sense? Now, on the bearish candle, we've got exactly the same points, except remember I said price closes lower than it opens. So in this case, we've got the open here because it opens and then it pushes up to the high, or it pushes down to the low, and then it closes lower than it opens. So this is the close of the candle, okay? So in actual reality, what you'll see in a real case scenario, you wouldn't see this very often unless there was some kind of gap. What you would normally see is a green candle like this, okay? So this would be green. Let's just color this green. And because prices closed up higher, you then see the start of the red candle or another green candle, or whatever color candle comes next. Let's just say this is a green candle, for instance, right? And then you might see, obviously we've closed here and opened here. So close, open, and then close, open. Then you might see a red candle, and this would be red. And that means that we opened and then we pushed down a little bit and closed down here. Make sense? Hope that makes sense so far. Now, I just want to give you an example of how this works on bars as well, just so you're familiar and you can really get it in your head. So let's take a look at bars instead of candles. So with bars, or what they're commonly referenced to is OHLC bars, which is exactly what we've just been speaking about. The four components, which is open, high, low, close, are exactly like a candle. In fact, you can almost imagine that there's a candlestick right here, okay? Imagine a candlestick right here, right? So imagine these are a candlestick like this. We've got exactly the same thing. It just looks different, that's all. So this is the open, this is the close, this is the close, this is the high, and this is the low. And the same, high, open, close, low, okay? Because we opened and then we close higher on the green, and then we open, and then we close lower on the red. So one's red, one's green, and that's exactly the same as the candlestick. They just look slightly different. It comes down to personal preference. These are obviously preferred by some traders and candlesticks preferred by others. It really doesn't matter. Whatever takes your fancy. I used to use these in my trading when I started trading all those many years ago, and then I transitioned over to candlesticks, and then I just became more comfortable and familiar with candlesticks, and that's it. So it really doesn't matter. But hopefully you understand how the anatomy of a candlestick. What I want to talk about now is certain patterns and kind of components of the candlestick that you'll need to understand in order to develop an edge as a profitable trader. So let's take a look at those. All right, so what I want to talk about now are two main components of the candlestick that are going to really give you an edge as a trader. The first one is the close, okay? So where the close happens. And the second thing is this actual wick, what we call the candle wick, which is either the wick to the upside or the wick to the downside. And I'll tell you why those are important. So you see this candle here, this is a relatively normal looking candle, a strong either buy candle, a strong bullish candle, or a strong bearish candle, meaning that we've either opened here and closed here, or we've opened here and closed here, and we've closed predominantly lower or we've closed predominantly higher than we opened, depending on what color the candle is, which you now understand. Now, what happens if the candlestick looks like this? Which it does. This is very common to see a candlestick that looks like this, meaning that, let's just say this is, well, it doesn't really matter what color it is, but let's just say this is a red candle, okay? So when we start to look at these candles, we can start to form stories about what happened using the close and the wick. So the close on the opens here, right? So this is the open, this is the close, but look what's actually happened during this session. So the close is very, very low. The close, in fact, is the low. So this is the close and the low. Even if you had a little wick here, that would be the low. It's still a very low close. Make sense? Which indicates that it's got strong selling pressure. The market is in a strong selling pressure scenario. Now, what we can also see, where the close tells us who won the battle, so in this case it was the sellers, we can also look at the wick, which also tells us a story of what happened during the session. So imagine like a game of tug of war. Imagine during, let's just draw on this candle here, for instance. Let's just say, we opened here, so this was the open, we closed here, but during the session, the candle actually pushed up, then down, then up, then down, then up, then down, okay, and then we closed here. Make sense? Or closed here, sorry. So there's this kind of tug of war going on, buyers trying to win, sellers trying to win, and then in this case, we close out kind of roughly in the middle. But in this situation here, what's actually happened is we've opened here, the buyers have tried to push this market right up, okay? This could be 100 pips, it could be 20 pips, it could be 50 pips in price, and then been rejected and slapped right back down, not only back down to here, but right back down to here. And then we've closed off the session, we've closed the hour, which shows us that there's a lot of strong selling pressure during this session. So now, no longer are we just looking at red and green candles and the open and close, we're now forming a story of what's been happening during each of those sessions. Make sense? Let's take another look at another example. Let's just say, for instance, that we've got a candlestick that looks like this. And in this case, this is going to be a green candle. Now, these can be green or red to be considered strong buying or selling candles because of where the close is and because of how that wick looks and how we can see what's actually happening during price movement. Well, in this case, we've opened here. The bears or the sellers have tried to push all the way down and then been rejected, and then we've closed right here, right? So in this case, what's likely to happen next is we're likely to see a continuation of an upward moving market. All right. Now, don't worry if you're getting a little bit lost. I'm going to continue this on with candlesticks when I go through the components of a successful strategy and a successful edge. But for now, I just want you to understand the anatomy and the open, the high, the low, the close, and then how to look at different components, being where the candle closed and the wick, and see that rejection and form a story, be able to form a story of what's likely to happen next. Okay, obviously what's likely to happen next isn't going to be enough for you to go and place your money into a trade. We're going to want to form some real confident bias with some backed up technical analysis to really inform that, put some weight behind that decision. But I'm going to show you how to do that. But for now, I just want you to understand, the different shapes of candles. You can also see a candle that looks like this. Okay, so where the low is the open and the high is the close, and there's no wicks, which means if it's a green candle, that is a strong buying candle, and the market is in strong momentum to the upside. Same goes for a bearish candle. If we see the open and the high here and the close and the low here, and this is a red candle, then that is a strong selling candle, which is likely to see the market continue down following the close of that candle. Make sense? So there's all these nice little nuances and nice little stories we can form of price when you get familiar with reading these candlesticks. So just wanted to touch on that before we move in to the other technical components. If you've got any questions at this point, please fire them below, and I'll be sure to answer those. And if you're getting value from this, remember to share this around and make sure that you're liking the video and sharing it to people that you think will find valuable as well. All right, let's get stuck into then the 6 main components of a successful trading strategy and a trading edge.
Şimdi Venüs'ün yeni bikini bölgesi serisini keşfet. Cilt koruma bariyeri sayesinde artık batık yok, kaşıntı yok.
Ben ekonomik olsun diye bidon kullanıyorum.
Ben aynı miktarla çok iş yapan Fairy ekonomisinden yanayım.
Yeni Fairy soğuk suda güçlü yağ çözme teknolojisiyle aynı miktarda en çok satan bidona göre 3 kata kadar daha fazla bulaşık yıkar. Yeni Fairy 3 kata kadar daha fazla bulaşık yıkar, cebinize iyi bakar.
Strategy and a trading edge. Okay, so first things first, we want to be able to identify the overall market condition. Now, you might have heard terms as bullish, bearish, and that's really what we're looking at. We're looking at whether we're looking at an overall upward market or an overall downward market, or it's just moving sideways. And there's 4 different conditions that I want you to be aware of. Okay, so the first one is bullish, and bullish is an upward market where the market is moving up from bottom left to top right. And that's what we call an upward trending market or a bullish market. The other one is obviously the opposite, where we're looking at a bearish market, where we're going from top left to bottom right, and we're descending down, and that is a downward moving market, a bearish market. Okay. Then we've got a ranging market, which kind of moves sideways like this, okay, and that's where the market's not either bullish or bearish, and it's just moving sideways. And then we've got like a choppy, indecisive market that's very erratic, and it moves and breaks structure, and it doesn't look very nice, and it's very choppy. And when it's indecisive like that, I recommend that you stay away from the market, because when we're in those types of environments, then we don't really have an edge, okay? So we're looking at a bullish market, a bearish market, or a ranging market. And if it's choppy and indecisive and we're not sure, then we stay out. Those are really the 4 main conditions I want you to be aware of. Now, obviously, I've just drawn these out and it all looks lovely. When you actually go into the markets, let's take a look at the charts right now. When you actually go out to the charts, it looks, it can look a little bit more ugly, but ultimately what we're looking for is the market condition. We're identifying whether it's a bullish market, a bearish market, a ranging market, or a choppy, indecisive market. And you can see this is the dollar yen, okay? And this is a chart of the dollar yen, and you can see that in this instance, if I just bring on my drawing tools here, you can see that we are actually going from bottom left to top right, and this is what we would call a bullish market, an upward trending market. Let's take a look at another example in the other direction. Okay, so in this instance, we've got the pound dollar, and in this case, we are trending downwards. We've got top left to bottom right, and the condition is bearish in this market. Okay, so this is an example of when the market was ranging. So if we bring on our tool here and go at the top and the bottom, you can see we've got these nice ranges where price action is bouncing off of the highs and the lows. And then finally, let's just take a look at some examples with a choppy, indecisive market. And you can see here that price is very, very choppy. It's breaking up and breaking down, and it's all over the place. So this is really, really choppy, indecisive scenario. So we want to avoid those as much as possible. Okay, so now we understand identifying the market condition. The next step is to identify the market phase. So let's take a look at what I mean by that. Okay, so in this instance on the dollar yen, we've got a bullish market condition. We've got an upward trending market. So the next thing we want to look at is the phase. Now you can see here we've had this upward phase, okay? And that's what we call phase one, or the run, okay, the extension. And then we've had this phase here, which is the pullback, right? And then we've had the next run up, and then we've had a pullback, and then we've had a run up, and then we've had a pullback. And each of these phases provides different opportunities depending on what we're looking for as a trader, whether we're looking to jump on the trend or we're looking to short the reversal or the counter move, if you like, to the trend. And there's many ways, there's different traders can trade different ways, and we'll talk about strategy development later, but these are the phases. So we've got a run, a pullback, a run, a pullback, a run, a pullback. And a run is the extension in the direction of the trend, and the pullback is the retracement, the outside return, the correction, if you like, the momentary correction before we continue to the upside. And of course, in a bearish example, it would be this in an opposite. So let's take a look at that quickly. Okay, so in our pound dollar example here, you can see we've got phase one, phase two, phase three, downward run, pullback, extension, pullback, extension, pullback. Okay, so the run and the pullback, you need to identify what stage the market's in right now. So first of all, we've got the market condition, bullish or bearish or in a range. If we're bullish or bearish, where are we? What phase are we in? Are we in the run phase or the pullback phase? And the reason this is important is because you wouldn't want, if we were on a bullish chart, for example, and we had a bias that the market was going to go up, what we don't want to do is buy in the middle of these runs. That's what rookies do. That's what rookie traders do. They buy in and they're in too late, and then the market starts to turn back, and then they get fearful, and then they close the position off at no profits. What we want to do is identify the pullback and then look to get long. Then look to buy the market so we get the best possible price. Now, on that topic, you're never ever going to catch the bottoms every time and sell at the top. Anyone telling you should do that, it's ridiculous. I've never met anyone that's accurately been able to do that over a long period of time consistently ever. So don't worry about that. But our job as a trader is to get in the best price as possible and then sell at the best price possible. Okay. So now we've identified our condition and we can identify our phases. You can see in this instance, we're in the pullback phase, and in a bullish trend, that's good because we could potentially get involved with some trading opportunities now. But that's not enough. What I want you to do now is understand the power of support and resistance. Okay, so this is another technical indicator, technical skill that you can develop and train your eye to identify that will then add even more weight to your case for entry into a trade. So let's just take a look at what I mean by that. If I just bring on my squiggle tool here, you can see that where we've pulled down to here, okay, in this pullback, you can see if I draw a straight line across, if I can draw a straight line, you can see that previous resistance is whenever we hit something like a ceiling, we refer to it as resistance. And whenever we hit something as a floor, we call it support. So on the way up, a downward move would be support, and an upward ceiling would be resistance. So whenever we're rejected from the high, that's resistance. Whenever we're bouncing off the lows, that's support. Okay, hence the names. But what we find is when the market is really harmonically moving in trend this way, normally the resistance level, which is previous here, which is the previous high of the previous run, normally becomes a decent support level. And I can just draw this on again here. If I just do this most recent one here, if I can draw a straight line, There you can see it again. The previous resistance becomes support. So that's pretty cool, right? Because now we can start getting excited about piecing this together and forming a real high probability move. Because what is a trading strategy? A trading strategy is just a series of patterns that happen frequently in the market that we build rules around that gives us a high probability of being right. And then when you trade that consistently, like a board game set of instructions, that is what you're going, you're going to come out with a profit. Okay, so that's all trading really is. So what we want to do is not just have maybe it will do this, maybe it won't, I think it will, it's likely to do that. What we want is a solid edge. We want something where we have high confidence in the fact that it's likely, very, very likely to do what we think it's going to do, because we never know what it's going to do definitely. All right, any traders out there tell you they know what the market's going to do, run a mile. All right, so far, we've got the condition, the market phase, we've got support and resistance, and we're using that to our advantage as well. So we're saying, okay, well, if we're in a pullback, let's start again on this example. Identify the market condition. We're bullish. What are we looking for? Bullish opportunities, buying opportunities. Okay, what phase are we in? Are we in a run or a pullback? When we get somewhere down here, there could be an area that all of the traders are looking at, or the majority of traders are looking at, that will provide a high probability area for me to get in and buy this position. Well, what's the first kind of filter that we can use? Support and resistance. Where's previous resistance? Well, price is pushing right down into that support level right now. What do we know historically? Well, resistance becomes support. There's a clue. Okay, look left, structure leaves clues. You might have heard the saying. There's our first clue. But we don't want to stop there. What we want to look at now is how price behaves once it gets down into that zone. So let's take a look at that right now. All right, before I go into that, I just forgot to mention something on the support and resistance. So obviously I mentioned support and resistance, horizontally, but there's also angular support and resistance that we can look at as well. So just to give you, remember, we're trying to think like as many other traders as possible to pinpoint an area that there's a high probability of a reaction, of something likely to happen, so that we can then place orders, right? What we're looking at here is, if I just bring on my tools here, you can see this is a downward trend, this section of the market, and we've got our phase one, our run, our pullback, our run, okay, and then we've got our pullback. On the pullback, we've also got previous structure support become resistance, okay? And we've also got, if we just look, if we draw a line here, sometimes what you can see is at each of the pullbacks, if you draw a line from the close of the candle all the way through the closes of the candles to the most recent one, you'll find that there is something called angular support, or in this case resistance, where we're hitting an angular ceiling. And when the markets are really in trend, they tend to respect these. Now, again, it's not an exact science and it's not a pinpointed price. But when we can align all of this together, we start getting a real high probability setup in our hands. So I just thought I'd share that with you as well. Now, I'm going to go into how we identify when's the right time to start really drilling down and looking at placing orders. So let's look at that. Okay, so the next thing I want to talk about is price. Okay, and how that behaves. Price patterns. What I'm talking about specifically is deceleration, so running out of steam. So we want to know when the market is likely to change direction, in other words. And there's a couple of clues that we could use to do that. If we're in a trending market, we can start to, remember what I said about the candles and how we had big, strong momentum candles, and then we started to read the story of how that might be starting to run out of steam, or how certain selling pressure was coming into the market, or buying pressure, depending on what direction we're going in. But we can use that in a trend as well. Not only can we use it in a trend, we can use it at the end of a trend. So if the market's trending and price action starts to show us that it's running out of steam, and then we put in a retest or something like that, then we can start to go, oh, right, okay, that's double confirmation that it's likely to stop here, this trend, and actually go the other direction. So what I'm going to give you is an example here in a trend. So you can see on this, this is the Aussie New Zealand, this example, and you can see that we've got our run and our pullback, and we've got our run and our pullback, and we've got previous structure support become resistance, right? And we've got angular resistance as well, and prices pull back up. And obviously all of these are in hindsight, but that's really the only way that I can demonstrate this to you, to give you as much value and examples in this beginner's program. What we could look for now is in this pullback phase, we can see that how we can really drill down and look at price here. So let's just start by bringing, let's zoom in a little bit here. Whoops, let me just, okay. What actually happened here is we had this strong bullish candle, and then we had another bullish candle, then another bullish candle, another bullish candle. But as you can see, they're getting ever so slightly smaller until we get this candle, right? Now this candle here, what did I say to you guys before? I said, this is completely different to this. This shows us that although it's green and we open lower than we closed, it's still a bearish candle. There's still selling pressure, because remember the tug of war story, the price pushed up and then pushed all the way back down and closed, okay, which is completely different to the previous story, following this strong momentum, and then we run out of steam, and then we see this selling pressure kick in. So remember, we're looking at the condition of the market, which is bearish. We're looking at the phase of the market, which is in a pullback. Now we're trying to see where price is likely to roll back over to go into the continuation of that downward move. And what we're using is support and resistance. We're using angular support and resistance. We're using price action now, and we're looking at deceleration. We're reading the story of price to show us when's a high probability, entry point, because we're never going to catch the top and sell the bottom, right? That doesn't happen. What we want to do is use our technical skills to get in at the best point possible. So when I look at this, I've now identified some deceleration, and I've now identified what we call a candlestick pattern as well. And this candlestick pattern is known as a high test candle, or some people refer to it as a shooting star, or there's many other names for these types of candles. But really, it doesn't matter. What we're looking at is the formation of the candle, and this is a high test candle. Now, there's other candles that you might pay attention to, like low test candle, if we go in the other direction, just like this one here or this one here. But as you can see, if you just look at any of these candles anywhere, you're not going to have an edge. However, if you look at them in the right place in the market, that's what's going to give you the edge. Make sense? Same with doji candles. Doji is a candle like this one here that just has a very, opens and closes at the same price. It's called indecision, where there's no decision. And a lot of the times you'll see doji candles that complete like this, where it's right in the middle. It's a tug of war that hasn't been won by either party. And again, they happen everywhere in the market, but if you use them and you identify them at the right place in the market, that can be added to your confluence, your confidence and confirmation that that's a good trading decision. It adds water to and weight to the decision, right? So one of the candlestick patterns, which is we've looked at market condition, market phases, we've looked at support and resistance, we've looked at price action patterns, right? The other thing that we can look at is candlestick patterns, okay? So there's other things like indicators like Fibonacci and exponential moving averages and that, but I'm not really going to go too much into detail in this beginner's course. You don't really need to know too much about that. Not at this stage anyway. Basically, it's just another way of adding another filter so that you get added confirmation. So just give you an example of one of the popular indicators that people use when we're looking for where the retracement's going to end is Fibonacci. It's called a Fibonacci retracement tool, and you essentially drag it on from the most recent pullback to the most recent low. And what you're looking for is usually one of the popular ratios that people look for is a 382 retracement for a trend. And you can see that 382 retracement is lining up in our zone here as well, okay? Now, some people look for deeper retracements at a 618, but really the 382 is the indication of a strong trend. So you can see it's another thing that we can add on now, because we've now got our angular and horizontal support resistance lines. We've got our the pullback phase. We've got the 382 retracement. You can also see here that we've got this even handle number. You see this 1.1000. Now, another thing that you could use to your discretion is even handle numbers. Anything that's on the flat or 500 or even numbers with 50 in them, they seem to be respected more often than not. So you can see that we've got 1.1 flat. That is a flat, even handle number. You know, when you go to the petrol station and you put the petrol in your car and you squeeze the pump and you try and get it on the zero, that same psychology is represented in the markets, believe it or not. And for whatever reason, these psychological numbers are respected. Lots of people take their orders or profits at these levels, which means we see movement in the market. So great, 1.1 flat, we've got all this confluence, all of this going in our favor. So all we need to do now is place an order, right? So we just want to place an order. And what I'm looking for is the candlestick formation as my signal to say, right, now we're ready to place an order. And I've already got my candle signal right here. Okay, so let's just take off this Fibonacci because it's a little bit, it's cluttering the chart. So all I'm going to do now is place an order just below the low of this high test wick. Okay, and I'm going to be placing a sell stop order. I'm going to go through orders in just a moment. But for now, if we go from the mindset of I'm just testing this out, okay, so I just want to see what happens. So all I'm going to do is I'm going to place an order here just below this low, and I'm going to put my stop loss up here. And don't worry, you don't know what stop loss is at the moment, but I'm going to explain what it is. Whoops, what's going on here? Okay, so my stop loss is going to go above this high. The entry is going to go below the low. And then what I'm basically saying is to my broker, I'm saying if price action pushes below this line, I want to get in at this price and I want to get out at a predetermined price, maybe down at the lows. Okay, so I'm going to say, right, in this instance, I'm going to test getting out down here at the lows, right, at the lows. Great. Let's see what happens. So we just let the market play out. We get triggered into the trade, and there's a high probability move. And look, not only did we get our high test candle wick here, we got a lower low, lower close than the previous low. This is called a 3-bar reversal. Okay, and we also got another rejection here. So added confirmation. Even if you didn't get in here and waited for this candle, you got even more confirmation because you could see not only did we get another rejection, we also closed even lower than the previous low. So then you could have placed your order here and got in. Make sense? So I hope you understand how we use that kind of multi-factor approach to looking at different components on price to really drill down and see where the high probability setups are. And forming a story of price allows us to predict what's likely to happen next. Then all we've got to do is go and test this historically. So a case of literally just going back in time, and every time you get this set up, practicing the moves, and going through it 1 bar at a time in real time, as if right, what we're in, the run or the pullback. Okay, great. What am I looking for now? Support, resistance, etc., etc. And you want to have a go at doing that, and you might want to pause the video to go and practice some of that. And what I'm going to go through now is what you're going to want to know in order to actually place an order. But before we do that, we have to understand the importance of testing this and how to test it. So let's do that first. All right, so from here, before we get stuck into the business side of things, which is going to be really important in terms of testing, profitability, making sure that you've got a solid system, and then looking at strategies and things like that, we first of all have to address something that's kind of the elephant in the room here, and that is orders, placing orders, and what they mean, what are they? So first of all, I'm going to talk about the different types of orders, and then I'm going to talk about how you calculate your position size, and then how you know exactly what order to place and where and when and why, and how much risk you've got at stake and all that kind of good stuff. So, okay, so what I want to start by giving you first is the terminology and the references used to describe different order types. Okay, and I'm going to write them out first of all. So write these down. We've got a buy limit. We've got a sell limit. We've got a buy stop. We've got a sell stop. Okay. And we've got at market. Now, at market. Now, those are the references, those are the terms that you might have heard when it comes to order placement. Now, I want to give you a reference or a kind of description of each of these because they can all be used in different ways, right? So some of you might be familiar with the term stop loss. Okay, well, a stop loss is the way we use any of these orders. Okay, so a stop loss is the way that you're using these orders, not exactly. So a sell stop and a buy stop isn't a stop loss. A buy limit can be a stop loss. A sell limit can be a stop loss. An at market order can be a stop loss if you've got a mental level that you're actively watching. And I'll explain more in a moment, right? So forget stop loss at the moment. I'll explain that in a moment. But these are the types of orders. A buy limit is a limit order where you're telling your broker, each of these orders are instructions to your broker, by the way. So first things first, a lot of people think that when they place an order on the chart, that is the exact level that they should be filled in, but it's not. It's actually an instruction to your broker to then fill your position at the nearest possible price, okay? I want you to understand that because I don't want you to be one of these people that blame brokers and things like that for, not honouring your order and all this, right? It happens. And when you blame brokers for things like that, it just shows the lack of knowledge on brokers. Now, there is obviously things that go on underhanded by some brokers, which is why I use Trade Nation, where they change spread values and things like that. I hate all that. And I would say if you ever experience that, get rid. But just understand that when you place an order on your chart, it's an instruction to your broker. Great? Good. So a buy limit order is telling your broker that if price pushes down below what we're trading at the moment, and we hit a certain limit, whatever price you specify to be that limit. So let's just say, for instance, that we're trading here, okay, and you're telling your broker. So let's just do this in a.
Burası Galapagos Adaları'nın kalbinde bir yanardağ ve bu yanardağın en büyük özelliklerinden bir tanesi sadece lav değil, aynı zamanda çikolata fışkırtıyor. Bakın, göreceğiniz üzere zaten her yer çikolata kaplı. İstediğiniz zaman böyle yerden bir çikolata kalıbı alıp yiyebiliyorsunuz.
Yok artık. Biz de abarttık ama.
Biliyorum, sosunu abarttınız, kekini kabarttınız. Tamam, dankek magma çok güzel, severek yiyoruz ama bırakın biz de bir şeyler abartalım ya. Yani hep ben böyle tamam abarttık. Abarttık biraz. Gerçekten çikolatasını abartmışsınız. Yani pes de olursa.
Yeni Herbal Essences. Gül yaprağı yumuşaklığı saçlarında. Gül özüyle zenginleştirildi. Hemen deneyin.
Do this in a chart fashion. So we're trading at this price, and you tell your broker, actually, if we push down to here, I want to set a buy limit order, which means if we hit that limit, I want to buy the currency. Okay, so basically it's an instruction to your broker to say, if we hit this level below where we're trading at the moment, whatever you predetermine that to be, I want to buy X amount of position. All right, and don't worry about position sizing just yet. So we set a limit order down here, and if price pushes down, your broker will then will put you in a long position. Make sense? Now, sell limit works the other way. So we're telling the broker, if price pushes up to this predetermined limit that I'm going to tell you, above what we're trading at the moment, I want to sell the position. Okay, so again, exactly the same thing. We're trading at this value, and you're saying, I want to set a sell limit up here. Okay, this was a buy limit. This is a sell limit, and if price pushes up to this level, you want to sell, and they'll put you in a sell position, a short position, right? A buy stop order is kind of the other way round. So let's just say we're trading at this level. You're basically, a buy stop order is saying to your broker, if we hit this level above what we're trading, I want to buy. Okay, so let's just say that we're trading here, and you say, if we push up to this level, I want you to put me into a long position. I want to buy at this level. So this is a buy stop order, meaning that you're thinking that the price is going to go up. And a sell stop order is the other way. So again, if a sell stop order is an order to your broker to say, if price pushes down below what we're trading at the moment to this predetermined level, please sell me, put me in a short position. Okay, I want to sell. So you place your order down here, which is be a sell stop, and then you're thinking that your bias is that market's going to continue going down. Make sense? So we've covered buy limit, we've covered sell limit, we've covered buy stop, and we've covered sell stop. An at market order is just you watching the charts live and clicking buy or sell and giving your broker an instant instruction as soon as possible to get you into that direction, whatever that might be, whether it's a buy at market or sell at market. So you can buy or sell at market, and that is, get me in now, sell now, buy now. Make sense? Now, all of these are orders, and they can all be used for target positioning, or they can also be used for getting into a trade, and they can also be used for stop loss. So now we've covered the references of each of these. Let's cover the three different ways we use these. Okay, so basically it's a stop loss, a entry order, and a target or a profit target, or whatever you want to call it, right? Profit target. And you can have multiple profit targets, but we're just going to stick with this for simplicity right now, okay? Now, first thing I want you to get clear in your mind is every order is an order. What do I mean by that? Every order is an order, and what I mean by that is a lot of traders we see out there, they put so much emphasis and attention and, effort and energy into trying to pinpoint the most accurate place for entry, which we was doing earlier, right? But when you think about it, your entry could be someone's stop loss. Your target could be someone's entry. And your target could be someone's stop loss, right? So they're all orders. They all behave the same way. So you want to think about putting as much effort and attention into every one of these orders, not just your entry, but your stop loss and your target. So you want to give the stop loss breathing room. You want to give your target enough, you want a decent sized target, but not too greedy in some situations. And your entry obviously needs to be precision as well, so you get that best probable move. So any of these orders that I've just been through here, buy limit, buy stop, sell stop, or at market, can be used as stop loss, entry, and target, okay? Depending on how you get in. So I'm going to give you an example of this on the chart in just a moment, but a stop loss can be a buy limit, a sell limit, an at market, right? Or it can be a buy stop or a sell stop, okay? A stop order is not related to stop loss. Stop loss is just a term for how we use the order. Does that make sense? An entry can be a buy limit, a sell limit, an at market, a buy stop, and a sell stop. If I could write a target.
Türk Jinekoloji ve Obstetrik Derneği orkide öneriyor.
I could write a target can be a buy limit, sell limit, at market, buy stop, sell stop. So let me give you an example of each of these. A stop loss, if market starts going against where we thought the market would go, and we want to get out of there, we could set a buy stop order. Let's just say, for instance, we thought the market was going to go down. Let's give you an example of this, right? So here's the chart. Let's just say that the market's trending and we get in a short position here, okay? So we set our order and we set a sell limit order here because we made the prediction here and we said, right, if we push up to that level, that's previous support, should become resistance. I've got enough confluence there. I'm happy to place a sell limit order and I'm going to tell my broker to just put an order there. You set it, you forget it, that's called a sell limit. And your idea is that the market's going to push down and retest these lows and you're going to place a buy limit here. Sell limit here, buy limit here. Because you're telling your broker, if price pushes down below the current price that we're trading at, I want to buy back my position. And of course, this order here won't be active until this order's active. Okay, but what if market goes against you, against your prediction, right? So you've put a sell limit order in. You've sold the position and market's going against you, okay? Well, what you would use here, so remember what I said about the broker, if it goes above the price we're trading at, you've already sold, so how do you buy it back? Okay, well, you want to buy stop order here, okay? So it's just a case of how you're getting in the market, how you're placing orders, how that relates to, how we're using the order, and then how the actual order works. And it only comes down to these 6 things or 5 things here, right? So you've just got to memorize this. You've got to really understand this. And then you've got to know how you're using each of those 5 things. And then you've got to understand how you place the orders on the chart. So let's go over to the chart and I'll just make this really, really clear by giving you some examples on there. Okay, so in real time, let's take a look at some of the examples that we could give on some of these orders, all right? So we're currently trading at 22,913, okay? And what I'm looking at is different orders that I might place. So if I was looking to sell this right now, okay, for whatever reason, I would place a at market order, right? At market order, and I would get in at market right here. And we're selling, I place an at market order. I've told my broker I want to sell, and we're in. Now, in order to cover my position, so basically I need to set a profit target and a stop loss. And I can use any of those orders that I just showed you for that, but they are specific to, depending on what order your entry order is. Okay, so if I've placed a sell order, I don't want to place a sell order for my stop loss. It has to be a buy order. I have to buy back. If you're selling, you have to buy back at your stop loss. If you're buying, you have to sell back at your stop loss. Okay, so if I set a at market sell order here, my stop loss order is going to be at a position where I want to be out of it because I know that I'm wrong. I've accepted that I'm wrong and I want to be out as minimal loss. So I predetermine a percentage of my account I want to risk on this, which is that all happens before we place the first order. I'm going to show you how to do that in just a moment. But the stop loss, let's just say we're going to place the stop loss above this structure level, okay? So the stop loss is going to go here. And the stop loss for this particular order is I want to place it now. So I'm going to get in the trade at market. I'm short. Now I just want to cover my position and I want to place a buy stop order here, okay? So a buy stop order, and that's going to be used as my stop loss. Now, why can't we use a buy limit order? Well, we can't use a buy limit order because remember what I said about buy limit order? A buy limit order is an instruction to your broker to get in at a price that's lower than we're currently trading, right? So that wouldn't be lower than we're currently trading, would it? So it would be a buy stop order. So just by figuring out and remembering what I said about each of those orders, the unique characteristics of those orders, you can work out, right, okay, yeah, it couldn't be that one. So it really only isolates it down to the right one. Now, for my target order, let's just say that I want to get in down here. I want to buy back down here at profit. Now, that could be an at market because I could sit here watching it and I could just do an at market order. It couldn't be a sell stop because we're already selling. It needs to be a buy.
Arkadaşlar şu anda arkamda görmüş olduğunuz aktif bir yanardağ ve bu yanardağ az evvel patladı arkadaşlar. Şu an
market order. It couldn't be a sell stop because we're already selling. It needs to be a buy, okay? And it can't be a buy stop because a buy stop order is getting in and buying more above where we're currently trading. So it has to be a buy limit. Make sense? So I know it's a lot to take in, but if you rewatch and get it in your head, you'll understand. So I've sold at market. I've got a buy limit for my target order, and I've got a sell buy stop for my stop loss. Right? Let's give you another example. Let's just say this time, if price pushes down to here, let's just say if price pushes down to here, I want to buy this. Okay, so if price pushes down, I'm going to tell my broker that at this level here, whatever this level is, 22.60, or something, I want to buy at this level. Okay, well, I could either wait here and buy it if it pushes down, or I can just set a buy limit order which is telling my broker that if we push down below where we're trading now to this level, buy me in. Okay, and then once I get in that, I need to set a stop loss, and I always want you to remember this: entry, stop loss, target. Entry, stop loss, target. So as soon as you get in, you think about your risk, and then you think about your target, and always do it in that order. So for this one, it's just an order saying, well, if price pushes down lower than what we're trading at the moment, I want to sell, which is a sell stop. So this is a sell stop. Okay, sell stop. This is a buy limit. Okay, and then for the target, which let's just say we put our target back up here where we were. So we want the market to push down, then we want to push back up and hit our targets, right? Well, what's this going to be? This could be an at market because we're sitting there watching it, or it can be a sell limit order. Okay, sell limit order. So you kind of get the gist, right? Now, is there anything that I haven't done here? Yes, there's a couple of ways. You know, you could do at market orders for everything. I highly recommend you don't use at market orders for stop losses because that's not a good idea. But I want you to just really get your head around the different types of orders and then how we use the different types of orders, and commit to memory those different differentiators that I just went through. You know, instructions to your broker. If price is above or below where we're at the moment, you buy or sell. And if you get your head around that, then we can move on to calculating position size and getting in on the entries. So let's do that now. Okay, so just to get your head around risk and order placement and risk management at a very, very basic level, let's just say that we are in a trending market, okay? And we're looking to get in around this level here. We're going to buy the market, right? And I'm not so interested in the profit target for this example. I just want to get you to understand risk and position sizing at a basic fundamental level. So let's just say that the price we want to get in at is 0.550. Okay. Now we're going to get in with a limit order or an at market order, or buy limit, whatever it might be, and we're going to predict that the market's going to go up. Now, to cover our position, we also need to put in a stop loss where we want to get out and accept that we're wrong with minimal risk, okay, minimal loss, sorry. So let's just say that, to keep the numbers easy, that this is 8,500. So here, between here and here, is a 50 pip gap, right? So there's 50 pips between our entry and our stop loss. Now, one thing I forgot to mention earlier is we're looking at the fourth decimal point. The only time that isn't the case is on any pair that contains the yen. If we have the Japanese yen in any of the pairs, we're just looking at the second decimal point. So you might see something like 13120, or this will be the 1 unit and this will be the 10 unit. Okay, so all the pairs, we're looking at the fourth decimal point, except for the pound yen, we're looking at the second decimal point, or the dollar yen, any pair with the yen in it. All right, so back to the example. So we've got a 50 pip risk limit. Make sense so far? Now, let's just say that we've got a $10,000 account. That's our total account size. Okay, and I'm just keeping the numbers. You might have a $1,000 account, you might have a $500 account, you might have $1 million account, right? But $10,000, let's just go with that because it's nice and round. And let's just say we want to risk no more than 1% on any trade, any given trade. Okay, so the first thing I'm going to do is divide this by 100. And that will give me 100. Okay, so $100. Makes sense so far? So 10,000 divided by 100, that gives us 1% of our account, or you can multiply it by 0.001 and get the same answer. And we've got $100. Now, what we want to do is take that, that's our risk, and we want to work out how many, how we put that into the order. So we've got a 50 pip risk in space, okay, in price, and we've got $100 allocated to that 50 pip risk of our account size, right? So all we need to do is take the 100 that we've got to allocate to risk and divide it by 50. And that will give us 2. And what is 2? $2 per pip. So let's just say that this here is a 2-to-1 move, meaning we're risking 1, but we're going to gain 2. That means if we're risking 100 and we've got $2 per pip on every pip the market moves, we're gaining $2 or losing $2 if it's below our entry. That means that if this is 100, this is 200. So we're risking 100 to gain what $200, which is a 2-to-1 risk reward profile. Now,
Öğretmenden az kullanılmış, full orijinal, sıfırdan farksız çantamı satıyorum. Çanta tabii. Siz ne sandınız ki?
Aklınıza gelen gelmeyen her şey sahibinden.com'da satılıyor. Anne bebek eşyalarından dekorasyona, giyimden mobilyaya kadar milyonlarca ikinci el ürünü komisyonsuz satmak için siz de hemen sahibinden.com'a gelin.
Now, I'm not going to go into lot size and everything just yet because the way that we buy currency is in units. Some, depending on the broker or the platform that you're using, the charting package, it will give you the option to put in a dollar figure per trade or per risk, per pip. And some of you will be looking at lot size, so standard lot, mini lot, micro lot, and that will all be calculated based on similar principles. But I'm not going to go into that just now. I'm going to go into that later on when we get in depth with the, with the numbers and real detailed stuff. But for now, I just want you to understand kind of, so I'm allocating 1% of my account to split across the amount of risk where my stop loss is going to go, my entry is, and then I can work out what my profit target will be because it will be the same value per pip. And then there's all leverage and all the rest of it, how you can access, how you can control a bigger portion of the market using leverage from the broker, and all of that I'll go through when I talk about brokers. But for now, I just wanted to cover this so that you understand risk management, position sizing to a degree, and how it's all relative to the potential profit that you can make on any one trade. Okay, so based on what we've learned so far in terms of a little bit about order placement, a little bit about orders, a little bit about the kind of 6 things we look for to approach a decent trading setup, the condition phase, the price action patterns, indicators, support and resistance, candlestick patterns. What I want to do now is just kind of do some practical stuff. I'm going to set you guys some homework as well, so you might want to pause the video after this section if you haven't already paused it multiple times already. It's a bit of a big one. And what I want to do is just pull out a kind of makeshift strategy, if you like, a trading strategy. I want to help you understand that a trading strategy is a series of events that happen frequently, a pattern that happens frequently. And if we're able to build rules around it, we can consistently trade those rules or test those rules to find it if it has a positive edge, a profitable, if it's profitable over time, and then we can go and trade it, right? Now, before I do that, I want you to understand everything I've taught you so far can be applied depending on what type of trader you are, whether you're looking for trends, whether you're looking for reversals, the ends of trends, whether you're looking for ranging markets. All of those things that I've taught you so far can be used to approach strategies and setups in multiple different market conditions. Okay, that's the first thing. Second thing, what's a great exercise to do is, let's just say that I bring on my horizontal line tool here, which you can find right here. And just a good thing to practice is just scrunch up a chart. If you've played around with the chart already, you can use the link below to open a free account with Trade Nation, and so your charts look like this. And then just practice going through and just put in horizontal lines on support and resistance levels, okay? And what you're going to see is that magic take place, right? Where we see, look at this. So we've got previous resistance becomes support, and then we've got resistance becomes support, resistance becomes support, resistance becomes support, right? And so on and so on and so on. And although it doesn't always respect, it does most of the time. When we see these really nice harmonically trending markets, support becomes resistance. So just doing this little exercise will, one, get your eye used to identifying structure, your support and resistance from your eyes, and two, giving you confidence and helping you see how powerful some of this stuff really is. So let's make up a strategy, and then what we're going to do is use that strategy to firstly show you what a strategy is made of, and then second of all, get your head around the idea of, I just need to go and test that now to see how it performs, and that will give me the confidence then to give me the probability of what it's likely to do going forward, right? So let's do that. So first things first, this is all going to be in hindsight. I have no other way of demonstrating it in an efficient way for this video so that you can, otherwise we'll be waiting here. I'll be taking days and days and days to film this thing, and I want to give it to you right now. So I'm going to kind of give you something in hindsight. I've just pulled up a chart randomly. I haven't really checked through too much here. I've just seen a couple of things that I think we could use, and I'm just going to create a trading strategy. Now, before I do that, some of you might be thinking, well, when is the best time to trade? What's the best time frame to use? Do I use the daily, the 4 hour, the hourly? And I would say this, if you can remember what I said about consistency, you have to be consistent. So when can you consistently be in front of the charts every day to do the routine, whatever that might be, okay? You don't want to be interrupted by meetings, school run, taking the bins out, all this kind of thing, right, that I say, or having a shower, bath, or someone gives you a call, right? So if you can only see, if you can consistently check the charts at the same time every day, once a day, you want to be trading on the daily time frame, okay? So each of these candles is 1 day. If you can do it 2 times, maybe 3 times a day, well, then you can consider the 4 hour. But remember, those times have to be consistent. There's no point chopping and changing and missing stuff and then trying to catch up, and that's not going to work for you because traders have a tiny edge, small edge. All right. So if you miss a trade, that can potentially cost you a couple of weeks of profit, or keeping you at break even. So you want to be consistent, and if you can check the charts more than 4 times a day, 3 times a day, then maybe consider the hourly. But look, this is a beginner course, and if you've watched this long, we're probably 2 hours in now, you're probably going to want to be a beginner, which means you want.
Evet hocam, ne diyorsunuz?
Şimdi devre arasına 12-0 geride girdik. Soyunma odasında çocukların karşısına geçtim, dedim ki siz bu skordan razı mısınız? Değiliz dediler. Razı mısınız dedim. Değiliz dediler. O an maçı çevirebileceklerini gördüm. O an dedim ki bu maç döndü. O an hatta şampiyonlukları gördüm. Kupaları gördüm. Bizi Latin popçularla buluşturacak azmi gördüm onlardan. Çıktılar, 4 tane daha yediler. Halbuki razı olsalar 12'de biter bu iş. 16 çok. Şu an herkes bizi konuşuyor ya. Siz de yedikçe abartıyorsunuz oğlum. Eğer hala yeriniz varsa pankek magma. Rahat olun. Kime diyoruz ya? Size şu taktikleri verebilecek dünyada 3 tane teknik direktör var. Biri ben değil ama var. Yani gelse şunu verirler. Olabilecek tüm varyasyonlar burada. Tutmadı mı öbürünü dene. Al feryatı, Şebnem'le yer değiştir. Ya şu çekmeden önce kendinize şu soruyu bir sorun. Benim daha önce oradan golüm var mı? Yoksa vurma. Rakip de ayıp etti ama şimdi. 16 nedir? 4'ten sonrası hiçbir şey yaramaz. Senin gol atmayı bıraktığın an bitiş düdüğüne denk gelmemeliydi. Abarttılar abi çok.
Yeni Herbal Essences, gül yaprağı yumuşaklığı saçlarında gül özüyle zenginleştirildi. Hemen deneyin.
Be a beginner, which means you want as less time at the charts as possible because you won't be able to handle as much going on. So I would say start with the daily time frame. All right. And for this example, I'm going to show you on the daily time frame. So what I want you to do is, first of all, I'm going to give you a strategy, and then I'm going to say, right, what I want you to do is go and test this strategy, and go and test it using all the different filters that we gave you before when I said, look at angular support resistance, look at horizontal support resistance, look at even handle numbers, look at indicators, look at price action patterns, look at candlestick formations, okay? And I'll give you a couple more candlestick formations to look at. So let's make a start, right? First things first, I'm going to look at this as a bearish trend, okay? We're going to say, right, we've identified the market condition is bearish, top left to bottom right, we're putting in lower lows, lower lows, lower lows, lower lows, okay? And we're in a bearish trend for this part. And what I'm looking for is a continuation setup, okay? So I'm looking for market to go to the pullback phase, and then I'm looking to sell so that I can short the market and come out at a profit down here. I can buy back my position down here at a profit. Okay, so look, let's bring on my squiggle tool. I'm going to draw all over this chart, so make sure you take notes. Now, let's just say that this was our last run, and then this was our last pullback. Okay, now what I'm looking for is when we get the pullback, I'm looking for the first lower low, lower close candle. So we're just going to assume for this one that we've pulled back into previous structure support and it becomes resistance, and we're in that zone just like we did before. And what I'm looking for is a lower low, lower close candle. And what that is a candle that closes lower than the previous low candle. In other words, we close lower today than we did yesterday. Make sense? Because this is hindsight, but this is a live, in real time, this is a live example. So this candle here, can you see this candle here? Right, this red candle, that candle closed lower than the previous low. Let me just remove that off so you can see it. This is the previous candle, right? And this is the candle that's just closed below the low of the previous candle. Make sense? Okay. And what I'm going to do once I see one of those candles is I'm going to place a sell order just below the low, 2 pips below the low. And I'm going to work out my stop loss, and I'm going to put that 2 pips above the highest high. And then what I'm going to do is I'm going to shoot for the lowest close for my target. Now, of course, this is in hindsight, but this is a good example of showing you the power of structure and the power of putting as much emphasis into your target taking and stop loss as you do your entry. And what you can see here is I was triggered into the trade on this next green candle. Then we pushed up a little bit because in real time, that is a whole day. Put your mind in the whole day of what's happening in this green candle here. We've pushed down, triggered into the trade. We've then pushed all the way up and we've gone into the red, about 50% into our stop loss. Okay, imagine that. Imagine your mindset, right? Then we've closed up here, higher than we closed like the previous day high. So that's it. That's it for the night. We've closed, then we open again at 10 o'clock in the UK or 1 minute past 5 in the US or whatever, right? And we're on to the next candle. Now the next candle starts to push down and we close down here. Great, but we're still like our entry, right? And then the next candle, we have a big bearish momentum candle, then another one, okay, and then 6 days later or 6 days later, we actually hit the target. But look what happens when we hit the target. We respect that level because it's previous structure support, and we hit it, we pause, and then the market rockets, rallies straight up. So this is the importance of putting an emphasis into where you take your targets. Don't be greedy. As it is, this is like a 3-to-1 reward to risk profile, which is amazing because if we risk $100, we've just gained $300 on this trade, right? But in real time, will you have the mental ability and the psychological kind of strength to stay in this trade and capture those targets, or would you take targets early? And if your answer is I'd take targets early, you're not ready to trade. That's something you really have to master. You have to let your profits run and cut your losses early. You don't want to cut your losses early. Cut your profits early, because you have to be. If you do that, you have to be right a hell of a lot of the time.
Ben ekonomik olsun diye bidon kullanıyorum.
Ben aynı miktarla çok iş yapan Feyre ekonomisinden yanayım.
Yeni Fairy soğuk suda güçlü yağ çözme teknolojisiyle aynı miktarda en çok satan bidona göre 3 kata kadar daha fazla bulaşık yıkar. Yeni Fairy 3 kata kadar daha fazla bulaşık yıkar, cebinize iyi bakar.
Bitmek bilmeyen çerez adam, çerezle muhabbet, klasik ve büftek soğan çeşitleriyle şimdi raflarda.
Hell of a lot of the time. Make sense? The shorter your target and the shorter your reward to risk profile, the more trades you need to be right on. If you're right 50% of the time and you've got a 1-to-1, you're not going to be profitable. Make sense? So in this one, it worked out. But I just wanted to walk you through, that whole process of visualizing being in this trade in real time. This one worked out. So remember the rules. We wait for the pullback phase. we wait for it to get to previous support resistance, or we just wait for the pullback. We identify where it's likely to end, and then we look for the first lower low, lower close candle. All right. Now, let's go again. So we put in our new low. We start to pull back. We start to see deceleration here, the previous support, and we put in a lower low, lower candle right here. Okay. So we enter a couple of pips below the low. And when we get triggered in, we put our stop above the highest high. And you can see in this case, started to push down, but if our target was down at the lowest close, this was more than a 1-to-1, probably a 1.5-to-1, but we actually triggered into the trade and then got stopped out. See that? We got stopped out. So we had to use our stop loss. We had to trigger our stop loss order to get out of the trade at a loss. So in this instance, we've gained $300 and we've lost $100. So we're up $200. Make sense? Cool. All being 1% per trade. And of course, that 1% is going to change very slightly as we gain more, as we grow our account. But I'm using it for this example. Okay, but what happens here is we continue to push up, then we see more deceleration, which is still a valid pullback, still a valid retracement, still valid phase 2, okay, pullback. And then we see market decelerating here, and then we get another lower low, lower close candle, right? So we place our order 2 pips below the low, we put our stop loss 2 pips above the high, and then we get triggered into the trade on the next day, and then we have a bit of a doji candle, which means indecision, okay? And then nothing happens, and then the next day we get a lower low, lower close, and guess what? We're going to put our target back down here again, okay? Lowest close, and boom, we've got what? 2.5-to-1 on this. So now we're up $450, $500, $500. Great. And then we wait for the new low. So we don't take another trade until we break and close below this low, and then we break and close below this low. So now we're down into the run again. Now we can wait for the pullback and we can look again. So here would be the next one, right? So we go into previous structure support, become resistance. We get our lower low, lower close candle, which is right here. And then we start to look again. So hopefully you understand the kind of, help if you could see that. Let me just move that so you can see that. All right, support becomes resistance. We put in our new run, and then we pull back up. We get our lower low, lower close candle right here, okay? So you know the rules. Pull back, look for deceleration, look for a lower low, lower close candle, and then targets, entries, sell stop order below the low. Stop loss is a buy stop order of 2 pips above the highest high. Targets at the lowest close from the previous run. Now, I know that sounds like a lot, but just rewind it back, get what I'm saying. It's not difficult. And you can look in a bearish market, and you look at this in a bullish market, okay? And what we're going to do is we're going to do some testing on this, and I'm going to show you how to test. I'm going to show you what to do. But when you're testing it, I want you to pay attention to bullish market, bearish market, okay? Do one for bullish, one for bearish. You can do the same pair, same market. But what I want you to make a note of is making sure you got the right market condition, making sure you got the right, phase, the pullback phase. And then I want you to take note of whether there's deceleration in price action. Maybe use a Fibonacci indicator just to monitor where it pulled back to on the Fibonacci. Maybe look at support and resistance, and then how many touches of support and resistance previously, and did you have angular support resistance in a shorting market or angular support in a bullish market? And then did you see price decelerate? Was there a pattern in price there, or was there a candlestick pattern? Was there a high test candle wick, or was there a doji, or was there a lower low, lower close? Okay, of course there's a lower low, lower close because that's the one we're using for this particular strategy, but notice if there was any other clues, like an indecision candle just before, like we had on this one, or where was it? Where we had it on this one. Was there one just before it, or was there any other clues that you can glean? So I want you to have a go at that. I'm going to show you now how to have a little spreadsheet set out so you can go and test and what to record so that you can efficiently start to get excited about, these strategy developments and how you can really use these patterns. We've just found a few there just without really looking, and you can go and test these. And the beautiful thing is this: everyone says trading's risky. Well, it's actually the least riskiest business I know, because what other business is, one, just you, so there's no other external factors that can play a part in whether you make profit or not. Two, you've got historical data research like this that gives you certainty in what's likely to happen next before you even spent a penny in the markets. You could really sit here for 6 months developing and testing systems before you've even spent a penny in the market, and then go, do you know what? I've got a 67% strike rate. This is going to potentially generate a 28% return per year on this one strategy. Amazing. Now I'm going to start funding my account, and you have the confidence to do that. Then most traders, the first question is, how much do I need to trade to start? Or let me just get in on this trade, and they don't know what they're doing. There's no need to do that. That's why it's got a bad name. That's why it's seen as risky. I don't want you guys to do that. So
Burası Galapagos Adaları'nın kalbinde bir yanardağ ve bu yanardağın en büyük özelliklerinden bir tanesi sadece lav değil, aynı zamanda çikolata fışkırtıyor. Bakın, göreceğiniz üzere zaten her yer çikolata kaplı. İstediğiniz zaman böyle yerden bir çikolata kalıbı alıp yiyebiliyorsunuz.
yok artık. Biz de abarttık ama
Biliyorum, sosunu abarttınız, kekini kabarttınız. Tamam, dankek makma çok güzel, severek yiyoruz ama bırakın biz de bir şeyler abartalım ya. Yani hep ben böyle, tamam abarttık. Abarttık biraz. Gerçekten çikolatasını abartmışsınız. Yani pes. Pes de olursa.
Yeni Sensodyne klinik beyazlıkla aradığın beyazlık ve hassasiyet koruması tek bir üründe.
you guys to do that. So let's build a little spreadsheet so that we can test this. I'll use this example and I'll show you what we're going to record on the spreadsheet. So let's do that. All right, so now what we're going to do is we're going to take what we just learned and we're going to try and do some testing. All right, now there's no wrong or right way of doing this. If it's your first attempt, I just want to open your mind to this stuff. I just want you to understand the process that traders have to go through to get a profitable system and have confidence in their system and then go and trade live, right? And I just want to reinforce again and say, this is all we've got to go on. As traders, the only thing we need is mental strength to trade a system where there's no real knowing of what's going to happen in the market. Any of these traders out there that tell you that you can make a set amount of pips per week or a set amount of money per week, it's rubbish. No one knows what's going to happen next. The income comes in sporadically. We're focused on overtime profits, okay? So with that being said, all we've got to go on is historical data to give us that calmness of the probabilities of what's likely to happen. And the importance of doing this stuff, is firstly, we need to know what's likely to happen next, okay? Because that's all we got to go on. Two, when was our longest drawdown period? When did we not make money for how long did that last? Or what was the most amount of money we lost in any one time? Or what was the biggest gain that we got in any one time? And all of this information feeds our brain with information that keeps us calm. Because if things aren't going well and you've just taken 3 losers in a row, you can look back at this and say, well, actually, every August this seems to happen. So this is perfectly normal. And it keeps you calm and you just continue to trade the plan. Because the moment you break the plan when you're trading is when you lose consistency, and that's when you're not going to come out on top. The other reason it's important to test is because this is a business. Trading is a business. And I know a lot of people don't see it like that, but with most businesses, you sell something and you get a unit profit, right? And a unit overhead cost, and the rest is profit. And you make the sale, you pay the overheads, you get the profit. With trading, it's exactly the same, except the overheads are broker fees, platform costs, losses, and the sale price is the wins, okay? And that doesn't come on a unit trade by trade basis. You don't win every trade. So it goes over a monthly, annually period where you're going, right, okay, well, I might have 10 winners and then 3 losers and then 8 losers and 5 winners, and it's very sporadic. So we have to have a plan that at least gives us a policy for making profit that we can look to, refer to, and go, right, okay, this is what I need to keep doing because this is normal. right? So that's the power of backtesting. And anyone that tells you that backtesting, you don't need to do it, I would ask them this: why wouldn't you do it? And in all my years of trading, asking that question, I've never had someone reply to me or give me an answer. Not even attempt to give me an answer, because there isn't one. Okay, so look, what I've got here is a very basic spreadsheet. We've got fantastic spreadsheets that we've created for some of my traders, and our traders have created amazing spreadsheets, better than the ones that I've used. But there's nothing wrong. This is Google Sheets. This is a backtesting spreadsheet, and all I've got is an entry date, or NT date. Got an entry date, entry time. It's handy to know when the date was that you got in, so when you reference back, you can find those trades quickly to see, oh, did this happen? Did that happen? Because you're going to have ideas. You're going to have other ideas to test, and you really go down a rabbit hole here. The entry time, that's important to know. If you're trading on the daily chart, obviously the time's going to be the same all the time, because the open and the close of the candle is at 5 p.m. Eastern Standard Time or 10 p.m. UK time. It's going to be the same every day. But if you're trading the hourly charts or the 4-hour charts, this could be up to 4 times a day, or 24 times a day, right? So it could be either currency pair, what market it is, and I recommend you just test one pair completely before you move on to any others. Time frame, trading. So time frame is the daily or the 4 hours, 60-minute trading system. So this is going to be like trend, counter trend, reversal, ranging, all that kind of stuff. We're going to look at trend for this example. Type of entry. In this case, we're using a lower low, lower close candle. Okay, so we'll use that. And then these are the notes set up. So you identify the condition, tick, phase, tick. Support and resistance, you could put a score here. So you look back and see how many times it touched, and then you count them up, and then angular, you just add as another one, okay? Or you could add 2 points for an angular, and that's your scoring system for monitoring support and resistance. Because you might find at the end of this that, all of the winners actually had 5 touches of support and resistance, okay? And you might just say, well, do you know what? Unless there are 5 touches of support and resistance and angular, I'm not going to bother. If it doesn't have 5, I won't bother. Make sense? And then that increases your strike rate. You get better quality trades. I'm not saying that will happen. I'm just saying that's an example of why we take these notes. Indicators. Make note of Fibonacci or any indicators that you might use. Or was it a 382 retracement? Was it a 618 retracement? You can start to get patterns. And every time you see a winning batch, you go, oh, that's interesting. They all hit the 382, right? Whereas the ones that hit the 618, they lost. They didn't generate a return. Price deceleration. Is there a price deceleration? So like smaller candles, right? Was there a candlestick, like a high test candle wick or a doji, right? So were they there? So you're making notes of those. And then you want to make note of the entry price, which is going to be 2 pips below the low, of the lower low, lower close, the stop loss price, which is going to be 2 pips above the highest high, or the lowest low if we're going in the other direction. And then target position, which is going to be at the lowest close. I've put target 2 and 3 in case you want to test and take it that far. I'm not going to do that for this example. And then the close date, close time, and where you exited the trade. Okay, so because you could exit at the stop loss, or you could exit at the target. And then you could use this to calculate total profit. All right, great, we've got our system. So what I can do now is I can bring this out and just pop this over here, and I'll pop this over here. Whoops, pop this over here. And now we've got our system, okay? So we can just start populating this, and I'm not going to do loads. I'm just going to show you guys how to do it, and then I'm going to leave you guys to do it, right? So let's go. So let's just say on this one, we let's start on this one here, okay? Because I think you can see that on the screen. There you go. So we've got the pullback phase. All right. Now you can make these as you can put that in here, or you can put check boxes to tick, tick, tick, whatever you want to do. I'm going to say pullback. Condition is.
Türk Jinekoloji ve Obstetrik Derneği orkide öneriyor.
condition is bearish, or downtrend, whatever you want to write. Support and resistance, now we can count that out. I'm not going to in this case because I'm going to have to scroll through the charts, but look, just put a horizontal line in where the, so you get the horizontal line tool, put it in where we're looking, and then scroll back and see, scroll back and see how many times that's been tested and whether or not we have angular as well, and you can count those up, put the figure in here. Let's just say that that's 5 tests. Indicators, you can bring on a Fibonacci retracement as I did before, and you can go from the low, the high to the low, and see if we hit the 618. So we hit the 618 there. So that's that, you'd put 618 in there. Okay, so 61.8%, I should say. I got in the habit of saying 618. It's actually 38.2% of that move is the 382. 618 is 61.8% of that move is the 618. So we just make a note of that. And again, we're just making notes. Let me just clear some of this stuff off. What else? Type of entry. So we're going to put lower low, lower close candle. Trading system is going to be trend, and the time frame is going to be the 1 day. And you can just copy all this stuff down as well, by the way. I haven't got like sit here typing everything out. Currency pair is going to be Aussie dollar. Entry time. Okay, so now we're looking at the entries, right? So if we just get our tool here, let's just get the crosshair, right? If you get the crosshair on Trade Nation, it shows you all of the cool date and time on there anyway. So you just have to hover over here, and we'll see that the entry would have been actually not on this candle, because we would have waited for this to close. It would actually have been on this candle, which the open and the close would be the same time. Okay, so it's going to be 10 p.m. in the UK because it's a daily chart. But we technically, it would be this day candle. Okay, so the 16th of August 2022, okay, would be when we enter the trade, because remember we're setting our sell stop order 2 pips below this low. So 2 pips below the low, you look at where the low is. If you hover the crosshair over the candle and look at the low, low's at 0.7011. So that means that the sell stop order will be 2 pips below that at 0.7009. Okay, so we can write that in right now. So let's just go entry date is I think it was the 16th of the 8th 2022. Okay, entry time is going to be we'll put 2200. Okay, and then let's see what we've got here. Let's see on the order info. So the entry price is going to be, what did I say, 0.7009. I think I said, didn't I? Let's just double check. 7009. Yep, that's the entry price. The stop loss is going to go 2 pips above the highest high. So look, this candle here, the high of this candle, 71.37. So we're going to be at 71.39. So 0.7. What was it? 7 high is 71.37. So 71. Where are we? Where's the highest high? Highest high 71.37. So 71.35. Sorry, 71.35 would be the stop loss. Target is going to be at the lowest close. Okay, so let me just remove all of these drawing tools. So just get rid of all of this. Get rid of this. Get rid of this. Get rid of this. And I'll show you where the lowest close is. So bring on the crosshair. Here's the lowest close right here. The close of this candle was 67.35. Now we're going to go 2 pips above that. All right. And that's allowing for something called front running, which is just a common practice to make sure that you get filled, because there's a little spread there and the broker might, not fill your order. So we want to make sure that we get filled. So the close price is 67.35. We're going to go at 67.39. So 0.6739. And that's it. Okay. Now, where do we close out? So the next information is all about the exit info. So the close date, well, let's have a look. What we're looking for is when we hit.
Arkadaşlar şu anda arkamda görmüş olduğunuz aktif bir yanardağ ve bu yanardağ az evvel patladı arkadaşlar. Şu anda gördüğünüz her yer lav içerisindeydi ve ben bu lavları üfleye üfleye söndürdüm. Hatta bir ara 3 tane küçük kaplumbağa gördüm arkadaşlar. Onları kurtarabilmek için devasa bir kaya parçasını taşımak durumunda kaldım. Hazır kaldırmışken şöyle biraz arka koltuğa alıştım.
Yok artık. Biz de abarttık ama.
Ya biliyorum sosunu abarttınız, kekini kabarttınız. Çok güzel dan çekmakma bayılıyorum. Ama bırakın biz de biraz abartalım yani. Bizim de öyle bir hakkımız olsun yani. Zaten buraya da yazmışsınız. Sosunu abarttık ve kekini kabarttık. Bu arada her an tekrar patlayabilir. Bizim hızlıca buradan uzaklaşmamız lazım.
Yeni Sensodyne klinik beyazlıkla aradığın beyazlık ve hassasiyet koruması tek bir üründe.
Is when we hit 6739. Okay, so I'll just put a horizontal line in here. And 6739 or 6735, whatever it might be, you can see that we hit here on this candle here. So if I bring back my crosshair, you can see this candle right here took us out, hit the target, and we hit that on the 6th of September. So 6th, 9th, 2022. So we got in on the 18th or 16th of August, and we got out on the 6th of September. So that's 3 weeks in a trade. Okay, again, think about what that is actually like in real time. 3 weeks in one trade on this one pair. Now you can trade multiple pairs and you can test multiple pairs and you'll have much more activity, but this is just this one. That's 3 weeks for the trade. Close time is going to be 10 p.m. Okay, so 2200. And then the position one exit is going to be at that price. So we just want the price of that. So it's going to be the target, 67.39. Okay, so 0.6739. And then you can put a little sum down here to calculate whether it was positive or negative, and you can calculate total pips, total profit, etc. I'm not going to do that here. I can do that later on. But that is basically it. So now if I just bring this across, you can see that we've got our entry date, entry time, pair, the time frame, the trend, this type of system, which is a trend in direction of the trend. Type of entry was a lower low, lower close candle. We've got a bearish condition, tick. We've got the phase pullback tick. We've got the 5 tests of support and resistance just as notes. We've got the 618 was tested, interestingly. Price deceleration, you can make a note of that. Candlestick, you can make a note of that if you've got a doji or a high test candle wick or whatever you want to call, shooting star. Some of you might be familiar with different candle names. Just observations. Tweezer tops. And then, did you see price deceleration? Yes or no? And then the entry price, stop loss, target, close date, close time, position exit, job done. So you can go and do this now. I'm not going to go through tons of these things because it's quite time consuming. And I don't want to. This video is already about 3 days long, so you go and have a go at this. Let me know how you get on in the comments. Let me know if you've got any questions. And what we're going to get onto next is really just understanding how we put all this together. So let's get onto that now. All right, so now you should have had a play in the charts and you should have done some testing, and you should have some figures populated in your spreadsheet. Okay, so if you haven't done that, I recommend doing that unless you're going to go through this again. But now we've done that, what we want to do is establish one main thing, right? Is the system profitable? And although, we gave you a demonstration of what to go and test, that's a bit of fun. That's not an actual strategy that I have any idea that will produce a profit. It was just getting you into the way of thinking about strategy development, how they're developed. Okay, because if this is the only way you're going to make money is to develop a system. All right, you can't buy strategies off the shelf and then go and trade them into the sunset. You need to know this stuff so that you can tweak them, optimize them, and make them fit your personality. Okay, otherwise you're not going to make money trading them. I know you could give the most profitable trading system to 2 people. One will make money and one won't. All right, so you need to know this stuff. So now what we want to do is it profitable? We just want to know if it's profitable. Now you've probably got a rough idea. You've counted up all of the kind of pips, negative, and taken the negative from the positive, and you've got a figure of positive pips for the period of time that you've tested, which is fantastic. And there's some other data that you can get from this, like how often you're right and how often you're wrong and your strike rate and things like that, right? But I want to kind of give you a little formula here that I think is going to serve you well going forward, particularly if you're going to start really developing this stuff. And I've got some really cool stuff that I want to share with you at the end of this as well that I think is going to help you. So first of all, let's do a positive expectancy formula. Now, not many people know about this. Not many people share this sort of stuff unless you're inside a prop firm or something like that. All right, so grab a pen and paper and write this down. First of all, we're going to do a bracket, and then we're going to do 1 plus open bracket W divided by L, close bracket, close off that as well, times P minus 1. Now, this here is a formula. And you're probably thinking, well, bloody hell, what does that mean? Well, you've got all of this information on your sheet potentially now. So I'll explain what each of these mean. P is going to be your strike rate, how often you're right, okay? W is your average win and L is your average loss. Okay, so it's really as simple as that. So let's just say, for example, that our average winner was $200. And our average loser was $170 because we was just over a 1-to-1. If we plug that into here now, so let's just go 1 plus 200 divided by 170, close that off, times P minus 1. We've now got those figures inside of our formula, right? Well, now let's start to work through this. So let's write this out again. 1 plus 200 divided by 170 is 1.18, okay? Close that off, times P minus 1.
Ne diyeceğini biliyorum. Dedektif Alex Cross. Bu olayla bağlantılı çok sayıda ceset var.
Onu durdurabilecek misin?
Yenilenen Elidor 7/24 şekillendirici bakım kremleriyle belirgin bukleler, onarılmış sağlıklı görünüm ve elektriklenmeyen parlak saçlar 7/24 hep seninle.
Minus 1. We've now got the next stage in the formula. So we now know our average win over our average loss. Make sense? Great. Now what we need to do is add 1. Right, okay, so we want to add 1, this one here, to the 1.8, which gives us 2.18. Pretty simple. And then we can times this by P minus 1. Now, P is your strike rate. So when you go through all of the wins and the losses, you might see, well, actually, I'm right 50% of the time. You might think, well, I'm right 70% of the time. Or you might be 55% of the time. Okay, so let's just say 55% of the time. So now we've got 2.18 times 55 or 0.55 because it will be a percentage, and then minus 1, okay, which then gives us 2.18 times 0.55 is 1.2 minus 1 equals 0.2. Okay, now 0.2 is your positive expectancy. That is your positive expectancy. Now here's the thing on this. As long as that is above 0, it's profitable. Okay, now the further above 0, the better. Okay, so now you know this. This is how you're going to analyze all of your testing that we're going to do from here on out, right? And I don't want you to get bogged down with the math or anything like that. I just want you to understand that this is how you work out if your system has a positive expectancy or not, and we're aiming for one above 0, higher the better. Okay. Now, what I want to do now is go through some demo trades. Because now we've tested, we still don't want to place any money at risk, because why would we? We want to then go and iron out any kind of user errors in the demo market so that we can understand how to place orders. I'm going to show you how to place orders in real time. I'm going to show you how to open a proper practice account, a demo account, so that we can actually have something there as a solid tool for our business that we can go and use so that we get certainty over our future returns and our future results as a trader. Based on our performance. So let's do that now. All right, so before we place a trade, you're going to need a platform. And I'm going to talk to you a little bit about the platform that I'm using here. And whilst this video isn't to kind of be biased towards a broker or a platform or anything like that because you're brand new. I've had quite a few broker accounts and platforms over the years, and over the years I've come to like certain features and really respect certain qualities of brokers. So the best thing I can do at this stage is just share with you what those are, and I'll start with the brokers. So I use Trade Nation. You can find a link below this video to open up a demo account. And if you contact the guys there, they'll actually allow you to set the amount that you want in the demo account. It's only fake money. But the good thing about that is because you can set a realistic kind of, a realistic figure that you can really, feel like it's real and it's realistic. And that'll give you some really cool motivation because it will be kind of as close to your personal situation as possible. You can see here I've got a $10,000 account this is based on, and this is a practice account, this is a demo account, and when you open the account it will look just like this, and you can choose all the different markets. Before I go into the charts and show you how to place orders and all the rest of it, I want to just say a couple of things about brokers. If you're picking a broker, I've done many videos on this. In fact, I did a whole video on my YouTube channel showing you how to analyze brokers and do your investigations and do your research. There's certain things that brokers are known for and got a bad rep for. Some, that isn't justified, to be honest, and some that is justified. So why it's not justified is brokers make money off of you trading, okay? They want you to trade. They want you to open an account. They want you to trade because they make money on that spread. Remember I said that when you go to the airport, they'll buy from one price and they'll sell to you at another price. And you never get when you come back and exchange it back, you never quite get, you never make money on it, or you rarely do from those kiosks because they're making money, the difference on the price, the bid and the ask, the buy and the sell. And brokers make their money from that, okay? And there's nothing wrong with that. And that is their model. Now, the reason that is kind of got a bit of a bad rep is because people try and flog brokers and they link to brokers and they say open an account with this broker, and you don't know where the intention is. You don't know where the motive is, and you don't know whether they've got your best intention at heart. So let me share with you a little insight. One, there's two really main important things that I really think are really important with brokers. One is that you've got a good communication path and good lines of communication to the broker. So the last thing you want is to have to ring up, go through a ton of security questions and get put on hold and then go through to support, and you're trying to close a trade and you have to go through all security and everything like that. You want to be able to just pick up the phone and talk to someone, an account manager, and Trade Nation provide me with an account manager that I know, that I can ring up. I also know some of the senior management at Trade Nation now throughout developing relationships because they're, in my opinion, a great broker. So that's really important, having a direct contact there that you can call if anything goes wrong. Second of all, I like to see.
Evet hocam, ne diyorsunuz?
Şimdi devre arasına 12-0 geride girdik. Soyunma odasında çocukların karşısına geçtim, dedim ki siz bu skordan razı mısınız? Değiliz dediler. Razı mısınız dedim. Değiliz dediler. O an maçı çevirebileceklerini gördüm. O an dedim ki bu maç döndü. O an hatta şampiyonlukları gördüm. Kupaları gördüm. Bizi Latin popçularla buluşturacak azmi gördüm onlarda. Çıktılar, 4 tane daha yediler. Halbuki razı olsalar 12'de biter bu iş. 16 çok. Şu an herkes bizi konuşuyor ya. Siz de yedikçe abartıyorsunuz oğlum. Eğer hala yeriniz varsa dankek magma. Dağıt oğlum. Kime diyoruz ya? Size şu taktikleri verebilecek dünyada 3 tane teknik direktör var. Biri ben değil ama var. Yani gelse şunu verirler. Olabilecek tüm varyasyonlar burada. Tutmadı mı öbürünü dene. Al feryatı, Şebnem'le yer değiştir. Ya şut çekmeden önce kendinize şu soruyu bir sorun. Benim daha önce oradan golüm var mı? Yoksa vurma. Rakip de ayıp etti ama şimdi. 16 nedir? 4'ten sonrası hiçbir şey yaramaz. Senin gol atmayı bıraktığın an bitiş düdüğüne denk gelmemeliydi. Abarttılar abi çok.
Yeni Sensodyne klinik beyazlıkla aradığın beyazlık ve hassasiyet koruması tek bir üründe.
I like to see the kind of agenda on what they're promoting, and if the broker is really promoting quality education and things like that, then they're probably going to be half decent, right? If they're just putting out Facebook ads to sign up for accounts and they're taking your money, they don't even care if you know about the markets or not. That's kind of that's not really a great approach. But that was kind of a bonus point. The second real main one is spreads. Okay, so it has been known that brokers change their spreads. And during the Asia session, you'll place a trade, or you'll place a limit order. And during the Asia session, which is the session after the New York session, so you have London session, New York session, and Asia session. During that session, the spreads become a little bit volatile, and they change the spread, and for some reason you might not get filled, and then you'll have arguments with them, and then you'll notice that actually they changed the spread, and they didn't honor the spread. They didn't honor what they said. They didn't fill your order at what it was when you placed it, which is, to me, a big no-no, right? Now, the reason I like Trade Nation is because they guarantee fixed spreads, and I've done a test on this on my YouTube channel, and I monitored 6 different brokers, and we looked through the times after the Asia session, and they just stayed on point, right? Whilst all the others were fluctuating, and I did that live in front of everyone. So that just proves a point, right? That I just like to have fixed spreads so that I know what I'm getting in at, what I'm getting out at, what I can project my profit at, and not only that, my back testing is more accurate. I can actually back test stuff with certainty because I don't have to allow for that fluctuation in spread. That sort of stuff you can't test, but with a fixed spread, you can. You can factor that in, and you can kind of go, right, okay, you can get more accurate figures. So anyway, enough about brokers. One other thing that you should know is there are brokers that have a book, B book, right? All brokers have an A book, B book, and they're kind of, if they think that most traders aren't good, okay? So what the broker will do is take the opposite position to your trade. They won't actually put your money through to the interbank market. They'll actually just keep the money and place the opposite side of the trade, betting that you'll lose over time, and they'll come out on top. If they do think that you're pretty good, then they'll put you on the A book, right? And that's where they'll take you a bit more seriously. But all this kind of stuff goes on inside brokerages, which is another reason why I like to have personal communication with the broker. But anyway, we don't have to worry about all that just yet, because we just want to know how to place a trade. So I don't know what broker account or platform you guys are going to use. I would say go and do your research if you're not going to use Trade Nation, but make sure you pick one that's reputable. Or go and watch my video that I did on how to pick a good broker. If you do open a demo account, just for the sake of this training, this is what you'll see. You'll see a nice little dashboard here. You can see I've got a practice account here of $10,000, and I've got all the different markets down the left-hand side, okay? And we're going to do FX because I'm primarily an FX trader. I invest in stocks, but I don't trade stocks. And I trade some other indices and stuff, but I'm going to focus on Forex because that's what we've been focusing on for this program. So I'm going to go, we've got the euro pairs, pound pairs, dollar pairs, all the kind of major different, or the 3 biggest major cross pairs. And then we've got the list of those there. So let's just go for pound dollar. And you can see some information like the buy and sell price. You've got the daily change in price. Okay, so where we're up to at the moment, whether it's down 1% or 0.5%, the low and the high of the day so far. Okay, so you know all this stuff now. You've got a trade button, which is going to be relevant for at-market orders, and then you've got an order button, which is for limits and stop orders. Not stop loss, stop, buy stop, sell stop. Remember, those are orders above and below price, and limit orders are orders above and below price, and an at-market order is just trade now. So that's how you need to remember it. Orders are for later, trade is for now. Okay, very easy. And then you've got some, you can put notifications on. You've got a chart button here, some more information about the pair. And then you can also add these to watch lists and things like that. So great. So what we're going to do now is click on the chart button, and I'm going to show you guys how to place a demo trade. And we're going to give you an example using the strategy that we did yesterday. And I'll walk you through step by step on how to place a trade and what all of the little what it all means. So let's do that. All right, so now we're going to walk you through placing a trade, okay? And we're going to just take an example of what we looked at previously, as in strategy-wise, and we're going to take a look at the Euro Aussie. So the first things first, when you're on this page or whatever your platform you're using, you want to click on the actual market that you're looking to trade or to analyze, and in this case it's the Euro Aussie. Okay, so what you do is you go over to this little chart symbol here, hit that button and it will pull up a new chart, and then you can expand that out, and you can do that multiple times. Another reason I love this is because you can have multiple charts, which you've seen me, on my other videos and stuff. It's very, very convenient to have multiple charts laid out so that you can just glance between them. Anyway, we're going to say we've had our phase, our run, our pullback, our run, okay, and our pullback. And what we're looking to do is get that higher close. I'm just going to pretend that we've done all the analysis, we've had all the major tests of structure, and we've got all the deceleration in price, because this isn't about that. This is about showing you how to place the trades, okay? So I'm going to leave all of the analysis to you guys. Otherwise, I'll be a long time analysing all the markets to try and find the perfect setup and then demonstrate that for you. If I was going to do a live trade, maybe we'll do that, but this is a demo trade, okay? So this is how you place a demo trade. So look, right away, we can see that we've got our higher close here, right? So if I just if I bring on the crosshair, just so you can see that this candle closed above this high, okay? So this candle closed at 155.71, and what we want to do is place an order a couple of pips above the high of that candle, and of course, because it's above where we're trading at the moment, we want to use a buy stop order, okay, which is an order, not a trade. If I wanted to place a trade right now, I'd be using the trade function, where I just place an at market order and execute my trade as soon as the broker, as soon as possible, okay. But because I want to place it above, that's going to be a buy stop order, which means we're going to place an order. So let me show you how we do that, right? So just before we go over to the orders, you can see we're going to place a trade at 56.33. Okay, so we're going to go over here, and you can also bring this up on the chart as well. So if you hit this button here, you can see that the trade thing comes up here. But I'm going to show you that in a minute. So where were we?
Ay, harika olmuş. Ya tabii sıcak suda yıkamadan lekesi çıkmaz diyorum. Ben de size alo diyorum. Fairy etkili alo soğuk suda bile zorlu lekeleri çıkarır. Elektrik faturanızdan 119 TL tasarruf etmenize yardımcı olur. Size alo diyorum.
Demet, dizi başlamadan yine bir tatlılık yapalım mı?
Kartor. Aşkın büyüsü. Vişne ve çikolatalı. En sevdiğim. Keşfetmeyi sevenlere çok özel bir tatlılık. Yeni Kartor. Aşkın büyüsü.
So where were we? 56.33. So we're going to go over to here, Euro Aussie, and we're going to hit order. Now you can see this order, right? And basically this accounts in dollars, so we're trading $1 per pip, okay? But I'll show you how to set that right now. So we're going to be buying, all right? So you set whether it's a buy or a sell order. And the order level is going to be at, what did we say it was? 156.33. So 156.33, okay? And what I'm going to do is I'm just going to extend this bit down. So if you hit this stop limit, because obviously we could just hit buy right now, or submit, sorry, and that would put that order in. But what we don't have is a stop loss and a target. The broker doesn't know where you want to buy your position back if you're wrong, or where you want to sell your position out if you win. Okay, so we need to tell them that. So I'm going to do all of that in one. You don't have to do it all in one. You can submit it and then edit the order to put in the stop loss and the target after. But I'm just going to do it all in one because I want to show you how this works. So basically, we know that we've got a $10,000 account here, right? Now, to work out 1% of that, we know we divide that by 100 or times it by 0.001, and you'll get $100. So we want $100 risk on this one trade, right? Now, if we go out to the chart and work out where our stop needs to go, so our stop needs to go right down here, okay? So our stop needs to go 2 pips below the low of this candle. So if we've got $100 at risk, we want to know where our entry is, which is 56.33, and now stop loss is going to go a couple of pips below this low, which is going to be, if the low is 53.86, it means we're going to be at 53.84. So when you take away 56.33 from 53.84, that is 249. Okay, so we've got 249 pips. So if we just divide that, 100 divided by 249, we get 0.40. So basically, all we can risk on this, if we're risking 1%, is 40 cents per pip. Now, that is a problem that you might run into when you've got these bigger, broader zones, because it's such a big zone, and this has got the Aussie dollar and the euro. You get bigger pairs than this. Something called the average true range, the ATR, and that basically is the average movement in price on these pairs. And the bigger the ATR, the bigger the bigger the profit and the losses on some of these moves. So we've got 249 pips. Okay, we can afford 40 cents per pip, right? So if we just go back to here, we just change this from 1 to 0.4, okay? And we're going to put a stop loss of, you can either set it in points away from your entry, right, which we know is 249, or you can put the actual price, right? So it doesn't really matter. I could put 249 here, and you can see we're risking $100, see? So just under $100 is there or thereabouts, $100. You can put, and you can see that's put 53.84 right in there, so that's bang on. The limit the stop is the stop loss. Okay, we've placed a buy stop order to get in, a stop loss, and the limit order will be the sell limit, which needs to go at the high. So let me just draw those out for you so you're 100% sure. Here is our entry with a prediction that we're going to push to the upside, and this is going to be a buy stop order. Okay, if that gets triggered and we move down and get stopped out, okay, this will be a sell stop order. All right. If we push up to this high, we will want to place, remember, if price is going to be above and we need to sell back, we want to sell limit order. So that'll be a sell limit order up here, and we're going to go for the highest close. So in this case, if I bring on the crosshair here, let's bring on the crosshair, go over to this highest close, and the close of this was 59.10. We're going to go 2 pips below that, so 159.08. 159.08. And this time I'll put it as price, so 1.5908. All right, and you can see we're risking 100 to gain 110, so just over a 1-to-1. And if you look at that profile there, you'll see that that's about right. So just to check through this, we are buying 40 cents per pip. Okay, we want 56.33 needs to be the order level. We need to put a stop loss 249 pips away, or at 153.84. Our target is a sell limit order at 159.08, and that is 275 pips away. We're risking just under 100 to gain 110. We want to make sure it says good till cancelled, and then we're going to hit submit. Okay, with the demo account that I'm using here, the minimum that we can enter on is 50 cents per pip. Okay, so it's just changed it slightly, which you'll need to double check. But this is just an example demo trade on how to place the orders. Okay, and obviously when we've got those big zones, that might be a problem. So you might need to only take trades when you can take above 50 cents per pip and stick to your 1% risk. So just to give you the demonstration of placing the order, that's all done now. We can hit, we can close that off. We can go and...
Burası Galapagos Adaları'nın kalbinde bir yanardağ ve bu yanardağın en büyük özelliklerinden bir tanesi sadece lav değil, aynı zamanda çikolata fışkırtıyor. Bakın, göreceğiniz üzere zaten her yer çikolata kaplı. İstediğiniz zaman böyle yerden bir çikolata kalıbı alıp yiyebiliyorsunuz.
Yok artık. Biz de abarttık ama
Biliyorum, sosunu abarttınız, kekini kabarttınız. Tamam, dankek magma çok güzel, severek yiyoruz ama bırakın biz de bir şeyler abartalım ya. Yani hep ben böyle, tamam abarttık. Abarttık biraz. Gerçekten çikolatasını abartmışsınız. Yani pes olursa.
Yeni Sensodyne klinik beyazlıkla aradığın beyazlık ve hassasiyet koruması tek bir üründe.
We can go and edit this. So if we just go to open orders, you can see our order here, which we can amend, we can change if we need to. And if we go to the chart now and hit our trade button, you can see that our trade's now here and it prints the orders on the chart, which is really handy because at a glance you can see where we're at, if we're in, if we're out, etc. Right? So really, really cool. That's how you place orders. And although my demonstration hasn't been like as accurate as it's really going to be in real time, I just wanted to show you how to place the orders. That's how it works. And just to give you another demonstration here, if we just go to I don't know, euro dollar. Okay, we'll take a look at the euro dollar, expand that out. Let's just say on this one, for instance, for whatever reason, we wanted to sell at market. So we wanted to sell this time. Euro dollar, what you'd do is you go down to here and instead of hitting order, you'd hit trade. And it would automatically, you put your pip value in. Let's just say it's 0.5 again. Or you could say a dollar, whatever your 1% is, depending on where you've worked out your stop loss needs to go, etc. And we just hit sell, okay, and submit. And then that will put us straight into a position there on the euro dollar where we are short. So we are now short the euro dollar on this practice account, on this account here. And then you can go and set your stop loss and your targets because you can just go and edit it. So you just go and edit the order. I'll just go to open positions, amend, and you can go and set all the stops and the targets that way. So that's how you place orders. And I just want to reinforce the importance of demo, ironing out any issues with demo, because when I went to college, I trained to be an electrician. And when I went in to do the practical, you went into these booths and they were all set up and installed by like the professionals, and everything was perfect. Everything was like plug and play, and it was all designed to be very safe, and it all just worked. However, when I went onto the building sites, that's when you see the nuances, right? That's when you step on the water pipe in the riser and you put a screw for a cable and you get a belt off of a neutral, and you all this kind of crazy stuff happens, and that's what you're finding out in the field, right? And electrical apprenticeship, unfortunately, you're doing it at your cost. Whereas in trading, you don't have to. You've got a demo account to find out all those nuances. So making sure that you're au fait with the order placement, you're okay with understanding what type of order and witnessing that spread, and just playing around with it for free so that you don't risk anything. So I'd encourage you to go and practice placing some demo trades. Once you've got your results and you've got a strategy, go and practice using some demo trades and see how you get on. Iron out any of those user mistakes that you can't test. And then when you're confident in your system and you're confident that you can actually do this consistently, then you can consider funding a real account, with a small bit of money at first, I'd recommend. And then it's exactly the same process. So just before we get into the really, really, really good stuff, if this wasn't good enough, I just want to cover leverage and margin because that's important. So let's talk about that quick. All right, so in a minute, I'm going to give you my own challenge. But just on this last piece here, I want you to be aware of lots, margin, leverage. You might have heard these terms banded around, and they're really, really important. And the reason I wanted to cover them last is because I wanted you to not approach learning to trade with this in mind, okay? I kind of wanted you to learn what trading's really about and the fundamentals of trading, and then how you can use this to really accelerate your returns. And I didn't want you to be swayed either way emotionally because of what I'm about to share with you. So the way I think about leverage, let's talk about leverage first of all. So think about when you buy a house, okay? Most of the time when you buy a house, you'll go to a bank and you will borrow some money for the mortgage, right? And what you put down into the property market might be 10% of that house value, maybe even less, maybe a little bit more, right? But let's just say that we've got this kind of seesaw here, okay? And I always like to draw it like this. And let's just say that you've put in 10,000 and you bought 100,000 house. I know that's not realistic in today's day and age, but let's just say, you're controlling 100K's worth of the property market by just putting 10K of your own liquidity into the market, right? And then when you sell that house, you get to keep the growth, the equity, and the profit on the capital gains of the house. And then you give that, you give whatever's left that you owe back to the bank, and then you keep the rest, right? And that's basically leverage. We're leveraging a mortgage product in the housing market. Now, where this is similar in trading is the broker will lend you money to place a trade, to control a much larger portion of the forex market or stock market. And you might have seen some horror stories on leverage in the with GameStop and all these kind of horror stories where people got washed out of the market because they were getting margin call, and I'm going to talk about that in a moment. But this is essentially how it works. Forex trading, for instance, is traded in specific amounts called lots. Okay, so 100,000. A standard lot is 100,000 units of base currency. A mini lot is 10,000 units of base currency, and then a micro lot is 1,000 units of base currency. So let's just say that we were trading 2 mini lots on the Aussie dollar. Okay, and that the notational value of that trade is $20,000. Okay, if the leverage is 1-to-1, that means you just have to put up $20,000 to, let's just say that it moves 100 pips. Let's just say that you get a $200 profit on that 100 pip move. Okay, well, not everyone's got $20,000 in their account, and not only that, would you want to put $20,000 at risk just at work just to gain a $200 profit? Well, brokers recognize this, and they know that not everyone's got a $20,000 account or even $10,000 account. So what they'll do is offer some leverage. And what the leverage is the same thing as a mortgage. They're borrowing you the rest, okay, so that you can place the trade, control a bigger portion of the market, and then get a profit, and then pay them back what they're owed, and then you keep the rest. Okay, so if the leverage is 100-to-1, which is known to be, that same trade example that I just gave you, instead of having to put up $20,000 for the trade to gain a $200 profit, you now only have to put up $200, and you'll end up with the same profit if we get 100 pips profit. Now, the reason this is a double-edged sword, and you need to approach this with caution, is yes, we can earn much more money, and we can, the profits are great, and we can use it to our advantage, but it's also a double-edged sword because if it goes against us, we can also lose a lot of money. And the way that brokers manage this much of the time is something called a margin. Okay, so basically, when you get into a trade, the bit that you put up and the bit that they put up, the bit that they put up is called the margin. Okay, and they say, okay, we'll put up this much, and we'll match you, say, and if you go below that amount, you need to either put more in your account to to make up for our part of the deal, or we'll close your trade. And a lot of brokers, they just close off trades without you even knowing. That's called a margin call. Okay, when you get notified, and sometimes they just close off your trade. The reason it's dangerous is because this could be infinite. If you keep funding the account and it keeps going against you, and you keep funding your account, that's where you end up in a situation like what happened with GameStop. And it's called a short squeeze in the stock market, where all the traders are, the market's going against them, and they've borrowed money to short the market, and now they've got to keep funding it, covering their position with the broker. Or they'll go, until they go bust, and that's a major problem. It's infinite downside. So you just need to be aware of that. And one, make sure you've always got a calculated stop loss that's the fraction percentage of your entire account. Use risk management rules well. Make sure that your broker does have your back and closes off your order and your stop losses and fixes those spreads. Make sure that you understand what you're getting yourself into when you're using leverage. Okay. And just approach it like a professional. If you approach it like a professional, you are going to have better long-term results, sustainable results that won't get you in a bit of a pickle. All right, so over the course of this beginner program, we've been through what to expect, your expectations, what you need in terms of the gear. We've looked at charts, we've looked at platforms, we've looked at brokers. We've also looked at strategy development. You understand what a strategy is, how to develop one, how to test one, how to really make it your own. And then we went into risk management and we went into navigating around charts and placing orders. And hopefully by now you have a much greater professional understanding of how to approach trading so that you can end up on the minority side of being a consistently profitable trader. But now I want to set you a challenge, because you might have seen all these crazy trading challenges around where they've got some kind of underhanded agenda to take your money and give you no real value, with the promise that they're going to fund your account and you pay to get in, and they know that most people don't make it as a trader because they don't teach you anything, and they know that 90% of traders fail. So and then they put pressure on you to actually make money in a set amount of time, which is completely against everything that you need to do as a professional trader, and every professional trader understands that. So I was looking at all these challenges and I thought, I want to set my own challenge. I'm so confident looking around at all the crap that I can take, especially after you doing this, that I can take someone off of the street and I can get them trading consistently profitable on a live account within 30 days. Now, what's more valuable? Punting your money into some broker and some prop desk challenge with the hope of being able to get through and then replicate that going forward, or ensuring that you know how to be a professional trader and you're ready to trade live after just 30 days. So I'm going to host the 30-day challenge. And not only are you going to get around a mentor, which is one of the most beneficial things any person can do to be handheld through their new endeavor, you're also going to learn about how to develop strategies that really suit you, what other indicators that I use that you can use to implement into your strategy to give you an enhanced edge. I'm going to talk about the buying and selling and who you're actually buying and selling from and the dynamics of that, so you understand that better. I'm going to delve deep into the platform and all the features and functions so that you understand how to use the tools that you've got at your disposal like a professional. And then I'm going to talk to you about all of my strategies. I'm going to give you all of my strategies, all my templates, all my watch lists, and I'm going to show you how I trade in trend, ranging markets and reversal markets, as well as using multi-time frame analysis to give me an even more enhanced edge. And I'm going to show you how I build my watch list, how you choose balanced sets of pairs of markets. And my goal is to get you trading live in 30 days. Are you up for it? If you got value from this, the 30-day trader challenge is just going to blow your mind, and it's an absolute no-brainer. And if you've watched this far, this is definitely for you, right? We can both agree on that. So get signed up. It's not going to be one of those crazy things where they charge you thousands of dollars. It's a tiny entrance fee. You're going to come and work with me and the other guys going through the challenge. And I promise you this, you'll learn more and be more professional in that 30 days than you will anywhere else. How do I know? Because I've seen it all. So I hope you found this program valuable. If you've got any questions at all, fire them in. And if you're ready for the challenge, click on the link below, get signed up, and I'll see you on day one. Can't wait.